I hope everyone is as fired up as me for this 3-hour show. Start with the second day of the Santa Claus rally. Spoos are up nicely. Can we clear 3,900? First part of the hour, Ryan Detrick, Todd Gordon, Cameron Dawson, and Gene Munster. We're going to talk about the rally this morning. Tesla's not participating. Let's find out who else will participate and will not. Mitch, for the special show, I don't think we have a special intro, but roll it anyways.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel O'Connor.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors. Let's run down the markets real quick. We got a nice open, nice rally to 3,950. The high from last week, we know where that's at. That's a double top at 39,1975. That's the key to this market really going anywhere higher. Dollar down 20 cents at 103.81. The bonds down a half a stick at 126.21. Crude hugging $80, up 38 cents at 79.94. Gold back over 1,800, up $12 at 18.1640. Silver over $24, that's up 34 cents at 24.26. And man, I say this every day. Bitcoin futures flat, down $5 at 6,775. I don't know if Triple D has made it back from Boxing Day yet. Has he?
They're trying to bring me in. I'm here.
Okay.
I don't know if I made it back from the blizzard, Joel, but it's been snowing up in my area. So the first day I was laughing at you guys. You down in Detroit, I was looking at your snow. I was like, I'm not even getting any snow. I'm like, it's mild here. You guys are all complaining it's so cold. It was 0 degrees. It was 32 degrees here. I was like, oh, this is good. Well, I got punished for that because the snow came and it's come hard. And we've got about, I bet you we got 2 feet of snow here in the last 2 days. So it's been coming nonstop. And today still getting a little bit more here again today, probably another foot overnight. So now getting hammered. There is so much snow on the ground. But then this warm-up's going to come. Are you getting the warm-up too, Joel? It's going to get hot.
A little bit. Well,
all the snow is going to become just slush, going to 45 degrees. So we got like 3 feet of snow on the ground. And then in 3 days, we're going to go to 45 degrees. So that's going to be fun.
School day? You get a school day today?
Well, they're off now on Christmas.
Oh, they're
holidays,
off anyway.
So they're all school days now. So, yeah, the kids are here. Family's over. So we're right in the thick of it. Everybody have a good Christmas?
Well, you know, mine are always good. What about you, Money Mitch? What did Santa bring you? And good morning to you. Sorry about your Finns, man. I was cheering for them, but they couldn't pull it out. The Lions became lionized.
Yeah.
But Mitch,
I was thinking, should I wear this sweater today or not? But like always, you got to stick with your team, win or lose, right? It's how it goes. Sometimes you're going to win some, sometimes you're going to lose some. Got to shake it off. Got to shake off that rust. But definitely it was a good Christmas. Ready to be back in the hot chair and, ready to finish off the year. Get ready for 2023. That's what it's all about today. That's why we got a special. We're giving the presents back to you guys today. As Joel got a special show for us today. We got over 8 experts on today. So stay tuned, team. You don't got to go anywhere. You might want to stick with us even after the bell.
So
let's go.
What's up? You guys got this schedule here. What's going on?
All right, let's do the first thing. Let's talk about what happened on Friday and if you expect this week to be that Santa Claus type of rally. Seems like we got the lift overnight. What do you guys think?
I don't like the higher opens. I like to buy them unchanged, right? And then ride it up. But I don't know. I don't think there's going to be a lot of fireworks on the upside or the downside. I mean, you can always say that. It just feels kind of tight on the upside. Like the sellers are there. Like I'm still getting out. I'm still taking my losses for the year. And then I just don't think people are on the downside. They're like, hey, this has been not the greatest year. Maybe I'll wait to the turn of the year. the first week of January. So I'm looking for a little bit of a seesaw market in the 2 days I'm going to be here this week. Triple D, what are you looking at?
I'd say the exact opposite. There's all kinds of action here, Joel. You are seeing complete separation here. The seasonality that we talked about, the value trade in the last few days, is you've got money managers buying those stocks that have been strong and selling those stocks that are weak, is like in capitulation mode here now. I mean, I'm looking at oil stocks all trading significantly higher here today. They've had a very good year. The banks are value stocks trading higher here. And then you've got the leader of the tech wreck, Tesla, down another $7 here. It's bounced a little bit here, I guess, in a few minutes. It's only down 6 here now. But I mean, it doesn't even matter if there's news, no news. There's news on Tesla all the time. And yeah, there's some news from Shanghai too. But I mean, this is just a disaster. But I've got to think that, come January 1, this could reverse. So again, the seasonality playing perfectly here. The seasonality would have kept you out of this trade, saying, no, I want to wait until the calendar turn when some of these trades turn. I do think you might get that in the first week. But right now, if you jump the gun and went early, you were getting severely punished for that.
What about, but still for like the whole, I'm very indexes, right? I mean, can the strength and the value and the bottom half kind of offset the weakness at the top? Because I'm looking at Apple, that's flat, that's got a hold 29. The other one, Tesla's the big drag, Dennis. But every day that stock becomes less and less of an impact on the index. So that's what I was looking for. A little balance here. And maybe holding steady here. I'm just not looking for a rip roaring rally. And last week's low is 100 handles away. But you know what? I mean, anything can happen in this market. Let's go. Tesla's shutting down some factories, Mitch. Let's go into individual news on that.
All right, let's get into Tesla here as they're getting reports from Reuters and Wall Street Journal. So 2 reports coming in here about Tesla over the weekend, that the company is extending production halts at its factory in Shanghai, citing people familiar with the matter, and also stating that this is due to resurgence in COVID cases among its workers. That's interesting too, because I'll just tie this in here, is that also NIO is also reporting a negative outlook here, and we'll definitely focus on Tesla, but just wanted to bring it in. NIO announcing it now expects to deliver 38,500 to 39,500 vehicles when it had an outlook of 43,000 and 48,000. Why I think this is, of course, important is because if NIO is missing, of course, their deliveries, is Tesla going to be missing also with the mentions of shutting down production?
I think it's just a tough road. I mean, they're been the player in EV, but the competition is coming. There's so many things here to be concerned about. But with all that being said, with all the negative news, with the Musk hurting the brand, with all of that, I mean, it's very oversold here now. If you're shorting it now, holy mackerel, are you chasing it? I think you need a bounce. I think if I was long at this point in time, I'd probably wait for the bounce to sell. I don't know if it's ever coming. I know, Joel, you just sold on basically in the free fall. Well, it was 50 points ago, which looks like a genius sale here now. It's been oversold. It went from $300 less than 3 months ago to 116 here now. What is the RSI you were talking about on the pre-market show here, Mitch? I mean, this is so massively oversold now that if I'd be scared. And again, with the seasonality and the turn of the calendar, I think, this just sets up fairly well for a bounce play. Not today, but on the calendar turn. We'll keep saying it. The value, you've got, the window dressing going on. You've got the strong getting stronger, the weak getting weaker, which is what typically happens during the Santa Claus rally. I know when we just have all these up years, everybody gets skewed and they just think the Santa Claus rally, stocks go higher no matter what. It's not the case. It's usually a continuation for individual stocks. And tech has been getting wrecked all year and value has not. And that's what you see. So, but we'll talk about this RSI. I mean, we don't talk a lot about it on the show, so we're going to throw this to you, Mitch. I'm looking at that chart you've got on the bottom, and I'm seeing it very low.
Yeah, exactly. And one of the things is I always think that there's only edge really on RSI in extreme moments, because what you're looking for is for a reversal style action, right? Well, Tesla hasn't gotten it in the last couple of days, even though the RSI is now as low as it's ever been. If you look in the past, at least standard RSI, it has not gone past 11.26, and that was time here in March in 2021 when we were getting this downturn in the market, the first downturn in the market. Now, of course, where we're down to 116 and down towards an 8 reading on the RSI. What does this tell me? That, yes, we are oversold, but that doesn't guarantee a bounce anytime soon. It could keep coming down, but it does show us there that what I would say Dennis is talking about. If you're looking at shorting now, just be careful because the rip back could be nasty.
There will be a nasty bounce here eventually. I think we just have to look at the calendar. I'm going to keep saying it. The calendar sets up well for the bounce play in early 2023, perhaps even the last day. Maybe they jumped the gun early here, but you're 4 days early. We still have 4 days of trading left this year. You're coming in now. I think could lose another $17, $18 by the time, the calendar turns here. So I don't want to be too early on this trade because it just seems to go down relentlessly every day. I do think there's going to be a bounce. And I'm not saying I'm putting Tesla in the long-term investment portfolio because I think there's too many unknowns going into 2023. But I do think when you start to see that bounce, and especially if it happens near that calendar turn, that you could see a quick 10, 15, 20% pop in this thing. And people be like, oh, what's the news? I'm like, well, the news is just so massively oversold. But to call that, it's tough. And if you've been playing for that, you're getting rocked. So
the only way you're going to catch this thing, is if, with multiple layers. I mean, there's no way you're going to catch the exact bottom. I see someone sniffing around here around 115 and a half, 116. There's a little bit of support there. That's all. That's all there is. I mean, if you want to catch this thing for a decent sized position, and wherever you want to start, you're going to have to go 116, 115 and a half, 115, whatever your next monthly low is. And I always go to this, and then somehow it works out. Your next monthly low comes in, I believe, just under 110 at 109.96. So that's the only way you're going to catch it because, on a day like today, it's thickening up. That's all I could say. 115 and a half, 116, you have a buyer from now. So if it shoots down through that level and comes back up, maybe for a whoops trade, I'm definitely not touching it. The bottom of yesterday's range, you could see that 121.02. And then I'm sure a lot of people would like to see that closing price from Friday at 123.15.
Waiting for the calendar turn for me.
Last
so I'm not looking at it. Now, trading, obviously, I trade it every day. Day trading is, one thing. I trade every day. But, as a swing trade long, I'm waiting for the calendar turn. So I'm waiting a few days here yet.
All right, let's talk also about the last China news that I want to bring in here. Of course, China has officially announced overnight that it will end quarantine for inbound travelers on January 8th. So I think this could definitely help for maybe some January effect into the beginning of the year. If you saw some China names, we're lifting some European stocks this morning. Let's take a look at like a BABA right quick, maybe a PDD. What do you think about these stocks? Do you think they get a nice push with this mention?
They're up a bit here, but they just continue to find sellers into every rally here. And again, you're running into similar problems. Yeah, in the last couple of months, some of these stocks have come back, but overall in 2022, most of these stocks are down. So you still have tax loss selling happening here as well to a certain extent. Again, the calendar matters here. I'm gonna, I'm like a broken record here, but we keep saying it. The weak continue to get weak in the last few days of the year. The strong continue to get stronger. So it's tough to just call a turnaround play with 4 days left. Is BABA, a good long-term holding? Maybe, but, there's so many issues there that we've talked about on this show relentlessly here that I'm just scared of China. So what's a technical say on BABA, Joel?
Right now, it's and you haven't seen this in a while. You see like a steady buyer, and I'm going back for the whole month of December at 85. It spent very little time under 85. So if you're throwing some out here, you're trying to pick a bottom, which is not always the best idea. I just see those multiple lows at 85. And then on the upside here, I see multiple highs at 95, just under 95. So play the range there. I think this one will be a fun one too to, mark that closing price, at the end of the year. But right now there's decent support at 85. And I don't think it could have as bad a year this year as it did last year. And also I heard some China nice talk. Didn't I see that on some headlines over the weekend? Or did I dream that they were looking at some cooperation. I know I saw some other negative news, but just kind of like the big tech stocks. If China could just stop going down, then that'd be a big help to the market.
All right, let's continue going. Nothing like a lovely holiday traveling, as it looked like plenty of people got their airlines canceled. More than 17,000 U.S. flights since Wednesday. Southwest Airlines is soon to not even be flying, it seems like it, because they canceled more than 70% of its flights on Monday and warned mass disruptions will continue this week. In comparison, right, let's take a look. Delta canceled 9% of its flights on Monday, United 5%, and American less than 1%. So if you wanted to know which one was probably the best, seemed like American Airlines had the least cancellation here. Definitely Southwest struggling 70%. They blamed it on multiple factors, right? They blamed it on shortages. They blamed it on, unexpected weather disruptions. So definitely
unexpected weather disruption, even though everybody's talked about the storm of the century here relentlessly for a week.
They said that fog in San Diego and things like that were affecting them.
Enough of this. Dude, you're really upsetting me. Guess who's traveling at Thursday on Southwest? Take a guess.
It's you.
Yes.
This guy
right here. Yep.
Oh man.
And you guys probably figured it out. The cat's out of the bag. Tomorrow's my last day of the week, last day of the year. Going out to Phoenix. It's a chartered flight, though. It's a chartered flight. So if they're going to get one flight off the ground, I will give you guys updates if it's going good. If you don't hear from me, you know what's going bad. But I'm on a chartered flight, 9 a.m. to the desert. I don't know. He's saying leave tonight. I don't know. I'm locked and loaded on this flight. But could it be? Lisa was telling me this last night. Of course, she's going with me. I'm not even going to look at the chart, and I'm just going to have faith that things. Yeah, it's a chartered flight. I am a Delta guy. It is. It's depressing. But we'll talk about that afterwards. I'm not too happy about it.
We'll see what happens there. All right, let's get out of love. Any outlook right there? Just quick technicals on there.
Joel. Oh, I just said I didn't want to do the.
I don't want to do it.
Oh, you want to do
it? It's down $1.52. Pre-market low. It should have helped. 35 was support. Now it's resistance. I don't know. There's nothing much there until maybe $33. But I am not going to be watching that stock at all today. Let's move on. I don't want to talk about it.
All right, we'll get out of the airlines. Let's go ahead and let's get into our first guest today. Some might know him. I'm going to call him the master of stats. Let's get to it. Ryan Detrick. All right.
Boy, the celebrity here, Ryan Detrick, Chief Market Strategist at Carson Group. I know you got your thinking cap on for me because we call you the stat man. Okay.
All right.
So what do you think about the Michigan TCU game and the Ohio State Georgia game?
What shocks me, first off, good luck traveling. That's going to be interesting. But I'm shocked that Ohio State is, I'm going to say, only a 6.5 point underdog versus TCU, a 7.5 point underdog. I mean, it is what it is. Georgia's, last I checked, really, really good. So maybe I'm just beat up from what you guys did to us, for whatever that game was. But still, yeah, we'll see. I mean, one play here, one play there, but boy, Georgia just looks pretty good. Although, like we can talk all day, I'll just add this: LSU did throw for like 500 yards against LSU with their backup quarterback. At Ohio State, they do have a good quarterback, good wide receivers, but you got to protect them. So, and Georgia's got a nasty, nasty defensive line. It'll be fun. So we'll see. But boy, wouldn't that be something to have the game again for the national championship? I don't know.
Yeah. Now I hope I'm not going too far on this, but you know what's better than beating Ohio State once in a year?
Well, I'd say beat them twice. I guess.
Twice, but if a national championship in the front of the year, bring on those Buckeyes.
In theory, it'd be a new year, but that's true.
Yeah, it would be a new year. It would be a new year. True. All right, listen. You have your stats, you have the market. If there's one thing we've learned in 2022, don't fight the Fed. Okay.
Yeah.
And it doesn't look like the Fed's going to be relenting anytime soon. I don't care, your Fed pivot people. How can you have a bullish outlook on the market in 2023 until we get some kind of tone from the Fed?
Yeah, you're right. First off, you see my screen, right? I hope you see that.
It takes a second.
Okay. Well, looks like it should be. I don't know.
There you go.
There we go. I did take a second, but we got there. So I don't even know talk about this one. I got some slides for you. I mean, I guess there's, well, you know what? Maybe I've got something. I mean, well, here you go. So yes, we absolutely need some type of a Fed pivot. And I know I'm not going to say anything too different than what other people, I'm just on CNBC, right? We're all kind of saying something similar. The data for inflation is really coming back quickly, right? I don't know what the Fed's looking at. I'll be honest. I mean, used cars are coming back fast. Rents are coming back fast. These private measures are really coming back fast. So you got to think to yourself, 15 months ago, the Fed wasn't worried about inflation. 15 months ago, the Fed said one 25 basis point rate hike. Now they're all hawkish. So we get that, but potentially it's just everybody's negative, right? I read Barron's 2 weeks ago, and you guys talk about these things. I mean, the put to call, I'd love to know what you guys think. I mean, Dennis, what do you think? That the put to call stuff we're seeing on Wednesday, an all-time record. There's huge equity put to call spikes. I mean, everyone's saying how bad next year will be, and I'll just add this, and maybe we can talk a little. So everyone's saying the first half of next year is going to be terrible. That's what I keep hearing everywhere I look. All right, but I haven't heard anyone say the first quarter, and this is what I'm showing now, and I know I've shared this chart with you a lot this year, guys. The first quarter next year is the best quarter out of a 4-year presidential cycle, up 17 of the last 18 times. Who knows? Maybe we're going to be down like everybody says, but that inner contrarian in me, with everybody being so negative and so much bad news, says maybe we could have a surprise, which this time a year ago, I think everybody was saying 5,000 on the S&P, let's be honest. I know there are a few people that weren't, but now we've got a lot opposite, and that's maybe one reason to be bullish, with the fact the Fed probably is behind the curve again, and they're going to become pretty hawkish after this probably next CPI print we see, whenever that is, in a couple weeks here.
Ryan, there's a lot of bad news priced in, and that is the bull thesis for 2023 is that you look at stocks like even like a Tesla, we were just talking about it. I mean, the stock's down basically 35 or 40% here in about 20 trading days, which is just an incredible sell-off. Mitch was looking at the RSI earlier, looking at it at 8 and hadn't been that oversold in forever. I mean, there is some stocks and some sectors that are massively oversold, and that's pricing in a lot of bad news. So it's a good argument for your sake of saying, hey, if 2023 isn't that bad, maybe, there is the potential for bouncing. But then you have other stocks that are like making new all-time highs.
Yep.
And I'm like, so it's like the tale of two markets. Value was the story from 2022. Does that trade continue in 2023? That's the question as well.
Yeah.
But I mean, we can say how bad 2022 was, and it was bad for Cathie Wood, and it was bad for your tech investors. But when you look at the Dow, I mean, it really wasn't that bad of a year here. So I would argue that in certain stocks, I don't think they've priced in much for a recession at all, where in other stocks, they're pricing in the end of the world. So, I mean, I guess it depends on what kind of investor and what kind of sectors you're looking at. I'm thinking, that there could be a little bit of a reversal trade come January, where some of those growth stocks have just been hammered, actually could rebound for at least a couple of weeks. But I don't know. What did the stats say, Ryan?
Yeah, great points there. I mean, the Dow's down 9% for the year. We're not saying that's a great year, but I mean, it's hanging in there. You mentioned individual stocks. I mean, industrials are a group we really like. Look at Deere, look at Caterpillar, right? I mean, these stocks aren't that far from all-time highs that are really outperforming. It doesn't look to me like a global recession's coming, when you've got Deere and Caterpillar as strong as they are. But bigger picture, I've come on to you guys, and I've said this a lot, like we haven't liked big cap tech. We haven't liked tech and communications, the money that we run for our advisors at Carson Group, right? We've been underweight those groups. We've been overweight your value names, your cyclical value names, which have done quote unquote better, right? It's still down. I get it, outside of energy and utilities, I guess, but for the year. But still, it hasn't been this terrible, horrible year unless you're overweight the previous leaders. And they could bounce, but I'll tell you, Dennis, we still are underweight those names in the next year. Yeah. That can change, right? But, literally on CNBC before I got to join with you guys, they said, Andrew's like, what would you change your opinion on that? I mean, we're all technicians on this call. It's relative strength. I want to see some relative strength coming from the technology before I get a little more optimistic. And we're not there. But I'll tell you one thing. I mean, I just did these numbers. So, let's say we're down 20% for the year on the S&P. We're down like 19, bouncing a tad today. It is what it is. You see it on the right there. It's only happened 3 times. I think it was 73, 2002, and 2008. The next year after a 20% loss since World War II was higher a lot, all right? I mean, you see it right there. So 27% on average. Real small sample size, sure. But I guess the key concept we're trying to stress is, listen, when you're negative in a midterm year, That following year has been higher 8 out of 8 times, 25% on average. When you're down in general, the next year is up 15% on average. I mean, there's all these things I can keep spouting, and I know, some have worked and some haven't, obviously. But I think the key concept, again, is be open to the idea that there could finally be some good news, not a terrible year like last year with wars and shutdowns and lockdowns and more COVID and all the stuff that happened. Well, I shouldn't say last year, I should say this year. But nonetheless, be open to some better times. And, one other thing I want to point out, everyone's talking about the Santa Claus rally. It is what it is. These 7 days are the most bullish. By the way, guys, today's day after Christmas for trading. I was looking, this day, this is crazy to me. Since 1950, right? The day after Christmas, so that's today, the first trading day, has been down 1% or more only once. That's once out of 71 times. You had
jeez.
Did I just jinx it? Did I just do it?
They'll be all hitting you on Twitter there.
Yeah, they're gonna get me now.
1%.
But so again, that's kind of what's normal. What's normal is usually you're higher these 7 days. We've talked about it, but you see on the screen here, when you're up those 7 days, the year's up 10%. It's one stat. I get it. But when you get that warning sign, when saying it doesn't come to town, the year doesn't do well, January doesn't do well. This is just something that, we're not investing blindly on this, but some of those clues, last year, one of the big worries, people say, what was the warning sign last year? Oh, couldn't say last year, say this year. This year, it was when I call it the December low indicator. When during the first quarter, the S&P breaks the December lows. It's very rare, but when it happens, the year's historically been very poor. Well, that did happen this year, right? And that was maybe one of the many warning signs that potentially we could have a rough year. But that one took place. That'll be one we'll talk about in the next year. If we hold the December lows the first quarter, usually you do okay for the full year.
So give me I know you got your stats. Do you have anything on how low you think we'll go this year and on how high you think we may go? I'm not asking where we're going to close because no one knows.
Right.
But we all can talk about the 3,500, the 4,200 high, the rebound. We just got there in just like a nanosecond. Do you have a range, an idea range for us?
Yeah, I mean, we think put it this way, we do think the lows of this bear market are in. We think it was October, right? We think it's a 25% bear market, non-recessionary. That's your average non-recessionary bear market. I know there's not many people saying that. 2,000 stocks on NYSE made a new low in June, all right? And then the S&P made new lows, but only 1,000 stocks made new lows in October. So you saw less stocks participating to the new lows. That to us is how lows tend to form. It's choppy, it's messy, but yeah, we wouldn't be shocked at all if we saw the 10 to 15% rally or gain next year. And again, that's just based on some of the things I've already talked about with the end of the world not coming. And a lot of, let me find, I do have one other one. Give me 1 second here. Where was it? I don't know where it was actually. I thought I had something here. Well, here it is. This is it. This came around recently. When you have a recession, right? We've never seen a bear market bottom before a recession started. All right. We are not officially in a recession yet. We might be headed to one, not our base case, but this is what that's showing. So the bottom line is it as easy as if we go into a recession or not? That's how we're going to do. Maybe, right? Because we're not in a recession. Those lows probably happen. That's our base case. The economy is still on better footing to us than people give it credit. The consumer is still strong. Things aren't perfect. It's a slowdown. Yes. Manufacturing's in a recession, probably. Housing, that's about 25% of GDP. The rest of it's the consumer that's still strong. So again, if we can avoid a recession, more of a slowdown, that means this slide I'm showing doesn't matter. But this slide does matter because if we go into recession, the lows are not in. And I think most of us would agree there.
Can you make me one promise?
Maybe. I don't know. Depends what. I'm not going to wear blue or cheer.
No, I don't do that stuff.
Yeah, okay, yeah.
But if Ohio State makes it to the national championship game and Michigan makes it, will you go?
Yeah.
Will you see me out there?
Oh, I don't know if I'll go. Yeah, I don't. That's in California. Where is it?
Yeah, SoFi Stadium.
Yeah. See, I mean, I'm a Bengals fan too. I almost rather go to the Super Bowl because I don't know. That one's out west also. So I've always got a problem with that. I think
stay out there.
Yeah, well, maybe oh my God, could you imagine? I might not live. I might not make it. I've said the Super Bowl should always be in Arizona one year and New Orleans the other. I think it's just flip-flop each year. I don't like how it feels like everything's out west all the time. I don't know. But yeah, I might have to come out there and see you. Maybe we can sit by each other and hit each other and stuff. That'd be fun. Yeah.
I don't know. You look kind of big, so I don't know if I'd be hitting on you. But anyways,
yeah.
Ryan Detrick, Chief Market Strategist at Carson Group, giving us an optimistic look at the markets. As always, Ryan, we'll be dialing you up early in the new year. So thank you very much for coming on. And what are you going to be on next? Good Morning America?
I think I'm on Bloomberg Radio tomorrow. That's just a phone one. I do want to thank my computer. So I took a charger down here. I'm in my basement, right? And it's my kid's charger. It looks just like mine. So my computer is on like 3%. So I think I made it. I was playing with fire right now, but we made it. So thanks to the computer. I got to get the right charger now. So.
All right, thank you. Mitch, give us some economic numbers. They look to be weighing on the indexes a little bit.
All right, so here we got retail inventories coming in at -0.3. We got wholesales inventory month over month at 1% versus a 0.4% estimate, and good trade balance for November at -83.35 billion versus a 96 -0.9 billion estimate. These aren't the most important numbers, so I don't expect to see big moves in the market, but just wanted to make sure that we mentioned them here. So got that covered. Looks like the SPY has just been kind of shifting around here. And I'm with you, Joel. I don't like when I come in and I see the SPY already up like it is, or the future's already up.
No,
it's tough day today. But I'll tell you
Triple
what.
D. Well, before we do that, Triple D, are you seeing any action in the stocks? I mean, they're selling off a little bit.
I'm seeing the same thing. I'm seeing the value stocks strong and the tech stocks weak. It's just more of the same thing. Nvidia is down, AMD is down, Affirm down every day, AirKK down every day, Tesla getting the beats down 5% here this morning, the leader of the tech carnage. And then again, oil strong. It's just the continuation. The banks are actually showing a little bit of strength. They have been weak a little bit, but the drugs relentlessly bad. Drug stocks are all green here again today. I do think they were still working 2023 as well. I mean, this is just the tale of this market, and this is the tale of what seasonality is. And this is playing out textbook right now. It's been a textbook year, and why not finish with the textbook last 4 days of the year where they punish the laggards of 2022 and they buy the winners of 2022? Exactly what is occurring here this morning.
All right, let's get out of the stocks. Let's get to our next guest. You guys ready? Let's get him on. The guy with the background. We know we love that background. Honestly, he's been making me want to get another desk because that's what I think he has. I think he has 2 desk game going on, but it's working out. Let's bring him on here. Todd Gordon, founder, NewEdge Wealth Advisors. Let's go.
Mr. Gordon.
Wow, what an intro.
Yeah, we got a special intro for you. So just starting out at the top, what's the biggest mistake you made in 2022?
Oh, he throws you the hard one right off the bat.
Wow.
Holy. Joel's tough today.
Joel, I thought we were friends, bud. And even moreover, if you said you're going to go out and watch a college game and you have not been to the Traverse here at Saratoga with me, you and I are going to have real problems.
Okay.
Biggest mistake I made. Boy. That's a tough one. That's a tough one.
Is that because there's been no big mistakes, or there's been too many big mistakes?
Yeah, it was a fine year. It was a fine year. I could have been a little bit more aggressive, I think. I came in pretty overweight energy. I still remain overweight energy in our 2 main portfolios in the wealth management. I think I should have scaled some back a little bit. And the other thing is I should have been more aggressive with my convictions. I think it's been a slow motion 22 VIX sell off. So it's been hard to really step into it. I had some inverse. I hold up PSQ. It's only a 5% allocation, which is an inverse NASDAQ. I'm trying to generate some outperformance of the benchmarks. Should have been higher. I should have been more aggressive with the conviction. I guess. Will you let me skate with that answer?
Yeah, I would say, for me, it's like, I love bear, the bear side of the market. And I just think that, when there were really some great bear opportunities that I didn't pounce on. Now that's harder for your long-term portfolio, right? Because you can't be moving in and out of stocks and you get in this long only, your long only mindset, and it's difficult. And also Dennis mentions there's dips and rips too. It's not always, shorting the market and waiting till the cows come home is not always the easiest thing. What about 23? I mean, I just mentioned it with Ryan. If you would have just followed one thing, don't fight the Fed, from early in the year, you wouldn't be all black and blue and, need the first aid and everything. So without a big Fed pivot, which I think we're all in agreement is not coming soon, what's your outlook for 2023?
I think we lost audio there
We
just
just
for a
lost
second,
Todd.
Todd. We lost your
Yeah.
audio for a second. Can you just check your
Just
mic
popped
for a
out.
second?
I was trying to read your lips, but yeah.
Yeah, just for a second. For some reason, Todd, just check the settings. For some reason, they might have changed. Little wheel bar at the bottom there. Go to audio. Make sure this mic's picking you up a little bit. Seems like for some reason we lost.
Test.
There
There we go.
There
We
it
got
is.
you. We got you. We got you. We got you. No,
Gotta go HDMI. Okay, got it. Weird. So, I guess what I'm saying is, what is the Fed pivot, right? Or is it cuts, or is it the rate of change of Fed fund increase going down?
there
And
you
I just don't understand how Jay Powell can come out and club us over the head, say 5.25 for longer than you think. Yet you look at 5+ year inflation break evens, you look at 5-year treasury rates, and they're all 3.8s, 3.7s, 3.6s. I just don't understand the game they're trying to play besides using words, as their tool. But at the same time, aren't they trying to repair some credibility or regain some credibility after buying MBS into a housing, dare you say, bubble? I just don't understand that game. The Fed is trying to call their hand. So I think they're going to have to pivot, which I'm going to say is, not going Fed funds on a 5 handle. And we might stop at 4.75 at the lower band, 5 at the upper, and then that's it. How much has earning revisions come down? Do we know where we're supposed to be for the year? Is it 220, 210 for earnings in the S&P? Have we seen the revisions that they are telling us are going to happen? And I'm asking you guys.
We have not seen it yet, at least not yet. I mean, we're waiting for Q4, then Q1. FedEx came and kicked us in the teeth a while ago, and that hit the market, but that stock seems to
they've had micro issues. I mean, you look at UPS over FedEx. I mean, that's nothing new. You look at like Target, for example, in the trading business. I'm short Target, put that up against Costco. I mean, those are executional mismanagement of the business issues, right? I mean, FedEx represented what's going on in the economy.
I mean, we have not seen that bad of numbers yet, to Todd's point. It hasn't been that bad yet. This is my concern, is that I don't think the Fed even starts to back down until we start to see, some of the numbers coming weaker. And I mean, this is like the catch-22 of the whole thing. I mean, yeah, the market, you want corporate profits and you want that. But then at the same time, we don't want that right now because we want the Fed to pivot and then we want the corporate profits. So I just don't know if I see that. And again, in certain stocks, to Ryan Dietrich's point, some of these stocks have just been beat up so much. Maybe some of this all bad news is priced in. But I don't know. There's a lot of other stocks and sectors that are close to all-time highs here. So I don't know if this is the kind of market that I'm that confident in that, the trend continues. We're all going to continue to buy oil stocks. We're all going to continue to buy Caterpillar and Deere. And the Fed, it doesn't matter if they pivot or not. These stocks are going to be okay. I'm not sure if that is the case in 2023. My own opinion is I think it's going to be a rough first half. I think the economy is going to fall eventually off a cliff suddenly. I think it's going to happen very quickly. I think the Fed's going to be like, oh my gosh, we overshot. And that's when they're going to be quickly trying to back up and say, okay, we need to now start thinking about interest rate cuts because this economy's gone south. What does that mean for stocks? Do they like it that, Fed's going to finally pivot? Or is it that the economies went south and they're like, they don't like these corporate profits? I'm not sure how the response
and they were behind
is.
They were behind the curve again, behind the 8 ball yet again.
I think so. I mean, I think the Fed is way behind. I think they've overdone it. I do personally think eventually that these rates are just going to hit. I think it just takes time. I don't think they need to raise anymore. If they just leave the rates where they are right now, they will bring inflation down because the spending will slow. But they're not of that. They're going to continue to raise, and I think they're going to overshoot as much as they overshot when they.
Do you think we go?
Cuts.
Do you think we get on the lower band? Do you think we get 5.25?
I don't know. I mean, it's hard to say. I think it's all going to depend on what, first of all, we're going to get fourth quarter earnings coming up very quickly. I don't know if the fourth quarter is going to be that bad. I'm more concerned about the first quarter 20. I think the holiday season looks busy to me out there. How's it look to you, Todd? You go there, looks busy still.
Yeah, we was part of the deal moving upstate here in Saratoga is we spent holidays with her parents in Jersey, and we were in New York City yesterday. We did the tree. I think I was laughing with you guys. The tree, Rockefeller tree, is from my hometown in Queensbury. So we went down and saw it way upstate New York. We saw it yesterday. Went through FAO Schwartz and did the whole thing with the kids. Man, it was cranking busy as I've ever seen. I thought New York City looked great. I think everything looks great. And just Ryan is a buddy of mine. I really, really like Ryan Detrick, and he's talking about value growth. And I heard you before you brought him on. Can I share screen and just kind of show you where we are in that value growth?
Yeah, for sure.
Yeah, sure. We love it. We love your
okay
charts here.
Share
Picture
screen.
tells 1,000 words here.
Share screen.
Speak some fibs for us. Speak some fibs for us. I love that.
I'm gonna hit you some Elliott wave. I have to.
Hit him hard with it, Todd. Hit him hard.
I've kind of gone in the closet with it a little bit. I'm sick of explaining and defending it, but it's always going to be a part of me. So, this is what's interesting to me. This is value growth. Your iShares value growth ratio back to 2006.
Wow.
And this has been value underperforming growth outperforming value. And we're breaking downtrend. We're breaking downtrend resistance here. So, is this rotation that we're seeing going to be for real and for sustained period of time? I could show you some sector rotation. I really, really like the rotation here. And just, this is each dot here is 1 week. You've got materials outperforming. This is going to be the S&P benchmark in the middle. Materials, industrials, healthcare has actually been coming off here in the last month or so. Energy far out to the right. I'm continuing to be overweight energy. I was listening to the discussion you guys had. I mean, if the energy earnings were not included in the S&P, it would have been a much more abysmal year. I mean, can they sustain the earnings that we're seeing? I still think crude's got a little bit of technical damage done in it as reflecting a slowdown in demand. So I wonder if that energy outperformance continues. But guys, what I can't get is look at XLK starting to sneak up here. This is going from pretty much the toilet down into improving. And that's when you start to get the rotation. And how do you count out growth with semis acting so well? And I understand semis are a smaller percent of technology, but the move that we've seen higher, from an Elliott wave point of view, that's a 5-wave move. And that suggests the trend is now up in semis. I tend to think, I agree with Ryan, those October lows might be in, unless the Fed is going to just drive us off the recessionary cliff and the Fed wants 3,200 in the S&P. I don't know. I mean, do you fight the Fed or not and just listen to what they're saying? And that's why I was posing that question. Are they really going to stick us with 5.25, 5.5 Fed funds when the rest of the futures market is saying it's not going to happen?
Todd Gordon, founder, NewEdge Wealth Advisor, on with PreMarket Prep this morning, and just we did a nice discussion off the FedEx and the UPS.
Yeah,
I mean, are we just coming out of like a whole reset from like the pandemic? Something. I mean, and that's why I know people are Powell did this and Powell missed that. He was transitory for too long. Now he's Powell right. I mean, we just went through. And some people say it's still not over, where, everything was coming FedEx, everything was coming UPS. You had to have technology. That's what you needed to get through the pandemic. Could it just be a transition, where, the reason your deer and your cats, and maybe it's going to be more about, the economy, old bridges and infrastructure.
Absolutely.
Yeah. And things that like we need. And things that we don't need, like the metaverse. And that might not be sexy for the stock market, may not be sexy for your tech stocks, but could it just be, that generational shift? I mean, any credence to that argument?
For sure. I mean, China's opening back up. They just took the zero COVID policy away. I own Deere, DE, great holding. I mean, you can own Caterpillar. The industrials look great from that rotation point of view. Industrials, and specifically defense, large machinery. And I'm trying to think, industrials have a lot of sub industries. Some have performed and some have not, but certainly heavy machinery, defense looks great. Industrials look solid. And then same thing within healthcare, could be a return to the old economy. So can we go back into a bull market without tech? I'm not sure. I think you were asking Mitch and Joel, sorry to go off topic. Can I show you one more little internals? Is that okay?
Of course.
Okay. Yeah, there you go, Mitch. How's the CMT coming?
Going good. Just took level 2, waiting for the scores and ready to keep it moving. Let's
Right
go.
on, man. Right on. Yeah, just kind of jumping all over. I'm not trying to talk myself or you guys into the bull case, but so do you guys follow the tick? I'm sure Dennis, you do as an old school prop trader, and I mean that with love.
Yeah.
Do you follow the NYSE tick?
No, sorry,
You don't?
I do not.
Oh,
No.
Used to be a really
Okay.
great short-term trading signal, but you're going to
Tell us about it though. We've never
long-term.
talked about this on the show.
Yeah.
Tell us about it.
This certainly it indicates institutional buy sell programs, right? Someone comes in, does a sell program, hits control S on the keyboard, sells the 500 basket, control B, whatever. So this is an hourly of NYSE tick in the green and white. And just to smooth it out, I put a moving average over it. And above is the S&P. And this is going to be the early December low, December 6th. This was December 14th. And then these are the lows we've made. You saw a pretty big divergence from this teal moving average, which is lack of institutional sell programs in the back half of December. I mean, maybe you could say, well, no kidding. They're taking the time off. No one's there on the desk to really push it around. But from a 60-minute, you're looking over the entire month of December. That's a pretty big divergence there, indicating lack of sell programs. And then Mitch, I told you I'd hit you with the quick Elliot. I got to do it. This is the gory guts of what we do, just to kind of get context of where we are, define your onsides, offsides, your risk. The way I put it with the research clients and money management is, look, this is the should hold level. I mean, you could make the argument that's 5 waves off the low from October, and that indicates there's a change in trend. And just the typical retracements that you look at, nothing crazy, 50%. 618, and then I do like the 786. That's kind of my retracement of last resort. The should hold zone in the S&P was 30 in the cash, 3784, 3712, and we got down to 3765. So right in the middle. We stayed clear of the must hold zone, which is all the way down 3613. The NASDAQ, no surprise, got all the way down to the must hold level, where the S&P only retraced half. The 786, which again, this is kind of some gory math, held the must hold level to a T. So as long as we're above 10,788 in the NDX, I still can see the model saying October 13th was a low. The minute this breaks, guys, I'm going back into hedge mode. And I think you hit me on the open and say, what did you do wrong? Not having enough hedge. And if we do break that 10.7 in the NDX, then my alternate scenario is we're going to have to listen to the Fed, and we're going to get down to the 3,200 in the NDX. So, the S&P and the S&P. So we might have to go back and hedge a little bit.
You got one more minute, Todd? Do you got one more minute?
Yeah, I'm all yours.
There's a specific reason that I did this. I want to bring in Cameron Dawson, and she's here is Cameron. Let's bring Cameron on, because hi, Cameron, how you doing this morning?
I'm great, thank you. How are you guys?
Okay, so I want to know if you guys are considering a merger of your two firms, because Todd, you are NewEdge Wealth Advisors.
Oh,
okay?
You got to put my first interview with Cameron. Cameron, I enjoy your work. Joel, shut up, please.
And Cameron, your NewEdge Wealth.
We're going to find enlightenment, maybe.
It's funny. I launched under a different name. It's in Cameron. You're going to think that I'm copying. I'm really not. The original, we just launched an RA a year and a half ago. We're just kind of slowly ramping up. The original name was Inside Edge. It's based on my old ski racing career, but it still is copying your firm. So I guess I'm sorry.
All right,
doing really good work. Thanks for that, Joel. I really am going to get you back on that one.
I know you're going to get me back. Quick question for Cameron before we let you go.
We love Todd, Cameron, because Todd comes on and actually interviews us. He's like, he passes the interviews back. He's so good at it that he throws it back at us. So we'll just let Todd.
I appreciate it. I mean, you guys are traders, and you run a really good show. Cameron, I mean, in terms of the rotation out of value or out of growth and into value with this new regime of higher rates, one is the Fed trying to drill us down and just stamp out inflation, where we're going to look at 3,200 and the S&P, or can they stay higher for longer and continue to see this bid in older economy sectors? And can we start a new bull market from the current leadership that we're seeing?
It's happened before. I mean, that's the lesson coming out of the 2000s, is that you saw obviously the big bear market within tech and growth that lasted for the next, let's call it 7 years, through the peak of the dot-com bubble. Of course, those stocks rebounded, but not nearly as robustly as what we saw coming out of the value-oriented sectors. And the value-oriented sectors led the market higher, but what's important is that it wasn't enough to bring the market to new all-time highs.
Right.
And that is such a valuable lesson, because the time it takes for you to make new all-time highs and start into a new trend once you've passed all-time highs, the time it takes for that to happen in a bear market depends on how expensive you went into the bear market, how high the valuation was when you started. And usually that valuation expensiveness really lies at the feet of the growth stocks, at the most speculative, growthy parts of the market. So it's possible for value stocks to lead the market higher, but I don't know if the market achieves, the traditional escape velocity without growth participating in a meaningful way, and without there being significant multiple expansion behind the market, which is why you really need to see a significant pivot by the Fed in order for us to get that escape velocity.
Right, and we're just fairly valued. Was it S&P 17 times forward earnings right now? Right, and I think on a 12-month basis. So we're not even cheap. We're just fairly valued, right?
How far we've come and how little we've traveled.
Right,
It's wild.
right.
For all of this pain this year, we would think that we've made much more progress on the valuation front. But even if I'm looking at like tech and growth stocks versus the market, tech still trades at a 20% premium to the market. Tech used to trade at parity with the market prior to the Powell pivot back in late 2018. So there's still pockets where growth stocks overall still trading at 23 times, pretty significant valuation premium. And that valuation premium doesn't make a lot of sense with a backdrop of a real interest rate at a 1.5%. Right. So I don't know if we've really taken the medicine on that front yet.
And that's the different. That's what's different now, is in terms of past recessions where real interest rates are. So many stats and stories are reported on nominal, where we need to be talking about real rates and where inflation peaks in there or factors in there. So anyway, sorry, Joel. And
no, that's all right. No, I love hearing two
it.
Smart people talk. All right, Todd, we're going to let you go. We're going to dial you up early in the new year. We're gonna finish up here with Cameron Dawson,
sounds good.
Chief Investment Buyer at NewEdge.
I'll be on CBC tomorrow about 2:00, guys. If anybody wants to tune in and laugh. So, guys, thanks so much for having me, Cameron. Great to speak with you, and have a great rest of the year.
Good to see you, Todd.
All right, Cameron. Now I've been following you, and you're pretty firm in the going down to 3,500 camp. I've heard some of your discussions, and you've been great with your analysis this year. Is there something that could happen that would change that scenario to you?
I think that the thing that would change it in the shorter term is that the recession comes later than anybody expects. And I think that's very much a possibility, given that we're seeing real incomes accelerate. We're seeing an improvement in spending, or spending holding up much better than expected. Look at Atlanta Fed GDP now for the fourth quarter, running at 3.7%. This doesn't have the flavor of an imminent recession. Now, there's, of course, big flashing yellow signs from the market in certain areas, like a very deeply inverted yield curve, which could be sending a signal of an imminent recession. We could talk about our preferred way to look at the yield curve as more of a timing signal, whereas right now being inverted doesn't really tell us anything about the timing of a recession. But I think that what could happen and maybe give a little bit of breath in the market is that you're not seeing the degree of earnings cuts that maybe the most bearish people out there are expecting. Now, we think that those earnings cuts will eventually come, and it's important to remember that the market is not the economy, meaning that you could still see economic growth chug along, but see earnings pressure mostly because of margins. Think of it from the perspective of a company that had pricing power all through the past couple of years, which allowed them to push past price onto all of their customers. That pricing power is starting to fade. You're hearing much more talk about discounts, much more talk about needing to clear inventories, but some of your input costs are still high. Labor is still high. Look at copper, breaking out above its 200-day for the first time in ages. You still have some of this inflationary pressure, but maybe your pricing power is waning. That means lower margins. So you could see your top line hold in okay, but margins fall. So that's where you get EPS pressure. So, it's really a balance here where we're looking and saying maybe the recession hits later. How resilient will companies be in navigating this environment? And then, of course, in the short term, it's all about positioning and sentiment that, means, what's the next step, 4,100 or 3,500? And I think that that's where we have to be nimble and tactical.
So
What about-
I want to just take
go
it
ahead,
back.
Alex.
Sorry, Joel. I was going to say yes. And we got this chat that goes in the background, and I'm really bad at it, where it says, okay, you go or I go, you go or I go. We'll let they're behind the scenes here, and I'm brutal at it. I never look, and they yell at me all the time for it. I didn't look again, so I apologize to Joel. I was supposed to say I'm going to go. But Cameron, I want to take it back to what you were saying with Todd about, where stocks are valued. And now you're talking about earnings pressure. So we can look at this market and say, yeah, we're trading 17, 18, 19 times, depending on, what your forward outlook is. But I mean, if those earnings start to come in, this market's going to look a hell of a lot more expensive than it does at this moment in time. So it scares me when you say that if you start seeing the EPS come down, and I'm with you on this camp. I think that EPS comes down, everybody's like, whoa, we weren't paying 17 times for stocks. We were paying 21 times for stocks. And now we're going into a recession. What were we thinking? I mean, what scenario does that take us to if we start to see earnings pressure here?
Well, I think the first thing is that there's the first part of a valuation move, which is really justified by fundamentals, by interest rates. There's a second portion of a valuation move that is really driven by fear and emotion. And that second portion is what takes you down to a very low valuation on a very low earnings number. And it usually doesn't last long. And so we can come up with these dire scenarios of putting 15 times on earnings down 20%, and you come out with with numbers on the S&P in the low 3,000s or the high 2,000s and kind of scare yourself into not being invested. Yeah. But usually those periods of time happen so very quickly because you don't put trough on trough for a long time. Now, I think that it is a real risk for the market that you have this earnings pressure and valuation pressure that's still yet to come. That's why I say, how far we've come, and yet we've not really traveled anywhere. We haven't gotten to the point where you flushed the estimate so much where you have a low bar. And that's where we talk a lot about the discipline around the 200-day. And I think a very simple framework is to say, if your trend in earnings and your trend in valuations is still lower, it means that your 200-day likely is still moving lower as well. So if you get oversold versus that, meaning like we were back in June or at the beginning of October, where you're trading 15, 20% below your 200-day, maybe it's time to not be so bearish in the very short run. Don't get scared into making rash decisions. But if you trade very close to your 200-day, that's when you don't want to be chasing the rally, because not much has changed. Really, when we look around, we still have the same pressures on earnings and valuations. And so that's where we don't chase rallies. We maybe trim some risk in areas where we can. And right now we're still sitting at just about 4 to 5% below that 200 days. So hardly a place where we'd go, okay, back up the truck moment, we have to get in. So I think that the real challenge for 2023 will be similar with 22, is that it's just this slow grind. That's why bear markets are just so painful, because you just get all this time that it takes to really shake out valuations, shake out earnings, get that 200-day trend still moving lower. And then it takes a real catalyst either on the earnings or valuation front for you to start turning that trend in another direction.
Cameron, let's. I just want to shift the overall focus here a little bit. We're really, we're talking about the markets for the year. But one thing, Dennis and I doing the show over these years, we know we're talking to different types of investors, right? And your deal, you have institutional investors or wealthy clients. But there's a lot of people, younger generation, listening to this show as well. And kind of what we were taught, over the years is, just keep investing in the market, right?
Yeah.
Just, buy, the perpetual dip. It's the best place, for money. And that's been the mantra for so long. There's been several hiccups, in the past and things have worked out. Is that, I mean, just with everything that's going on, is that, I'm talking to people maybe that are 30 or 35 or, and then move up to 40, 45. I think the people that are older maybe have their money and are trying to preserve the capital we have. But, what do you have to say to the new generations of investors?
Yeah, I think the first thing is don't try to be a hero and try to catch an ultimate low of a bear market. They say that nobody rings a bell at the bottom. And I think that with that, it's really important to have a disciplined approach to when you want to be adding. And mostly in this kind of market, adding on days when you are, and like I said, very simple. When you're 15, 20% below your 200 day, you might not be catching the ultimate low, but it still is good to keep you in the market and keep you invested. So you're not doing the opposite, which is selling at the bottom. One of the things I say, as financial advisors, we really only have two jobs, which is to prevent people from buying at the top and selling at the bottom. And that kind of goes against this, when I say to prevent people from buying at the top, it's very important because we do have lost decades in markets. And if you had bought in 2000 at the peak of the market at the NASDAQ, it took you over 14 years to break even. And people will come back and say, oh, well, if yes, Amazon fell 90%, but then, look at its gains after. Tell me one person who probably would have had the stomach to be able to ride that out. So I think discipline in euphoric times is really important. And that trend work is important when you're overbought versus the trend. Look at back in 2021 when small cap stocks got, I think, almost 30-40% above their 200 day, and they were sideways and have been sideways to down and underperforming ever since. So that discipline of saying, okay, when we are well below trend, I can be a buyer, step in. I might not be catching the ultimate low, but 2-3 years out, I still think that I'll have good returns. And then making sure to be disciplined on the upside when we're really extended, not trying to chase these big rallies, because at the end of the day, like I said, lost decades are real. And, lost decades tend to happen when there's been major shifts in financial markets. And that's certainly what seems to be happening under the surface today. Whether we have a lost decade or not, remains to be seen. You usually only see it in hindsight, but I think it's still important to be disciplined.
Okay, Cameron, you have one more minute here for us, because I want to bring in Gene Munster, who has been following the markets for decades, and Mitch, I love Gene here, and we got him audio only, managing partner of Loup Ventures. So I guess I'll put a couple bears on at the same time. Gene, I know you've been very cautious this year, and for good reason, but I just wanted to bring you on here for 1 second with Cameron and see if you had any questions for her.
Yeah, I missed some of the earlier parts, but I'm just curious how you think about earnings and the depth of the reception. I think right now the S&P is showing around 3% growth for next year. What is that number? What do you ultimately think it's going to get to? And what point do you feel that it's the buying point? Do you wait till the numbers flush out? Do you wait till, do you move before then? Do you move after?
Yeah, to answer the last question first, usually you're buying before the earnings number is completely flushed out. Usually the street is very behind on estimate cuts, as you know very well, Gene. And so what tends to happen is that you see cuts begin, and it's kind of like the Sheryl Crow song, except its second cut is the deepest. So the first cut you let happen, then you have the second cut, and as you start going through this process, you don't want to wait till the last cut to be a buyer, because usually like I said, the sell side trails this. Now, just to put some numbers behind it, we're still sitting at 234 for S&P 500 earnings. That implies that 3 to 5% growth for next year. We think our best case scenario is 220. 220 would be flat on a year-over-year basis. 220 is flat earnings year-over-year is what's happened every year after a non-recessionary tightening cycle, meaning when the Fed raises rates, but we don't have a recession. You've seen about flattish earnings. So that's kind of our best case non-recessionary scenario. And then you start marching down to 200, which would be a very mild recession. Median decline for earnings during a recession is 20%. Average decline is 30%. So if you actually get that 20% down, a median EPS decline, you're looking at 190. And then, of course, if you have a bigger recession, something that looks much more like a GFC, then you have earnings estimates cut even further below 190. So we've been using a range of 200 to 220 kind of as our reasonable range of very mild recession to flattish no recession as where we're baselining. And if we go back when we had that CPI day rally and we were trading at 4,100, we were trading at 19 times that very optimistic 220 number, or 18 and a half times. So market's not cheap. Estimates aren't low. We have more work to do.
Okay, final question. What kind of a recession do you think is priced in now? No recession, mild, moderate?
I don't think that there's any recession priced into the equity market now. I do think that there is a recession priced into the bond market, meaning that the cuts, 50 basis points of cuts that are priced into the back half of 2023 are definitely pricing in some kind of recession. And given the fact that the yield curve is deeply inverted, which is because you see this pricing in long yields, 10s, 30s being so low on the yield side of things, clearly there's some recession worries within the bond market. It could be more of hedging than actual bets that we have a recession, but I don't think that there is one priced into equities today.
All right.
Thank you.
All right, Cameron, we're going to let you go. Excellent as usual. And now we got some tough questions for Gene. Thanks again, Cameron.
Thanks, guys.
I really appreciate it. Gene, you've been conservative this year. I've talked to you a couple different times, and I've talked to you during these rallies and stuff, and you've sat them out. We're really at a pivotal time here. I know you covered the markets, the original tech crash. Doesn't it seem like this is different? That like these stocks aren't coming back? And I mean, there's always, the few winners and losers, but taking your observations, from back then and applying them now, what would be like a realistic view for the markets and for these tech stocks?
I think, unfortunately, we still have another piece down. And the contrarian side is the market generally doesn't move in consensus. But I think that, and you'd think just listening to commentary around the market that everyone is negative, everyone in quotes is negative. I think the reality is it's been such a difficult year for tech is that there's this kind of hidden optimism. I'm negative, our fund 50% in cash. There's this kind of hidden optimism, like we're just going to rally back. It's going to rip back. And I think as long as that is out there, that optimism, I don't think that the markets have bottomed. And even though it may not be spoken, I think that there's kind of this optimism. It's just been that bad. I mean, some of these companies are down 90% plus, and these companies are going to be around for a while.
All right.
Musk, what about, and again, I want to go, Gene, I want to go into like Elon Musk, and what about, let's take this into the Tesla talk, because this has been the poster child for this year. I mean, it really started basically in the last quarter here, but we're seeing this relentless selling in Tesla. And I know like some of it might be brand, but is some of this, economic related? Are they worried, the competition's coming? I mean, this relentless selling pressure in Tesla is amazing to me, and it's a retail loved stock, and retail's absolutely getting punished in here. What are your thoughts here, Gene? First on Musk and then, on Tesla.
Well, I think Musk he's doing the right thing. I suspect he's going to step down from Twitter. I think that's going to be positive for Tesla. It'll give him, at a minimum, it'll give investors a sense that he's more engaged. He will be more engaged in Tesla, and I think that's generally positive. He's not going to be CEO for Tesla for a long time. I suspect within a year, 2, 3 years, he'll move down. He said as much. but he's still going to be really involved. And I think as long as he's involved in products, I think that should kind of comfort investors. So when that announcement comes, hard to say. If you go back and rewind, just kind of shifting towards the stock, if you rewind what's happened over the past 4 years, 5 years, you had a period where they made a lot of progress, but the stock got no credibility, or got no credit for that. They were delivering, they were leading the EV, pioneer EVs, and yet the stock just didn't do anything because there was a pretty strong bear case that they're just going to go out of business. And then the switch flipped, and people realized that they're going to be around, and the stock went higher fast. And the bear case during that time was they're going to run out of cash, they'll never be profitable. The other car makers are going to catch up, and valuation. And over the next 2.5, 3 years, every bear case has been kind of addressed. They've addressed them with the exception of valuation. And I think that's what's happened here more recently, is that there's still this debate around valuation. And what we've seen from other companies is that the stocks can go lower than what people think. And so I actually think that the fundamentals for Tesla are generally positive. I know there's talk of headlines today of production shutdowns in Shanghai at the beginning of next year related to the Chinese New Year. Well, that's pretty typical. Now, there's been a recent Twitter Spaces, where Elon's been pretty negative, but like he's always been negative in a sense on Tesla. Not always. There's been times he's been positive, but he's hard to read on that front. So what does all this mean? Is that as long as there's concern about the market, as long as that investors are debating mild recession, no recession, moderate, severe, as long as that goes on, is that higher multiple stocks are going to be disproportionately hit for it. And I think that's kind of the base case. And then there's the case of what happens if I'm wrong? What happens if fundamentals actually start to slow a little bit in the near term? I think that could create another leg down. When you put it all together, I don't know what the stock's going to do over the next 3 months. I do feel they have some inherent advantages on traditional auto. I think their traditional car makers are in a tight spot. It's just not about making an EV. It's producing it at scale at the right cost. So I'm still optimistic on the company longer term. I still think that this is going to turn out well for investors, but I have no idea what's going to happen in the next 3 months.
Where do you get in the turn here, though? I mean, again, so maybe as a long-term investor, if you're still optimistic, and I look at Tesla and think, wow, here's the stock that, is trading 60, 70, 80 times earnings. It's coming in, looking at a forward multiple of 27 and thinking, holy cow, just suddenly Tesla has become not, cheap, but a lot more reasonable relative to itself than it's been maybe ever. Is this just a fantastic opportunity? Do we just, maybe there's more downside in the next 3 months, but 3 years we'll be happy buying at 116? Or, do we got to wait until we actually get a turn here?
I think if you have a view of beyond a year, my sense is you're going to be fine. And I'm basing that on a belief that traditional car is going to be in a tighter spot. And what that means when I say that is that Tesla is still going to be able to sell the best vehicle for the least amount of money, which is good for market share. So I think that that's going to all play out. They have optionality value. They have solar business, which is going to get a benefit next year related to some of the Inflation Reduction Act and some of the 30%. That's an acceleration in terms of some of the benefit. You get the benefit of maybe other stuff, whether it's around Optimus. I'm not optimistic that that's going to play out. I think FSD is still going to be real. So I think all these things, to answer your question, I think a year plus. I think for right now it's call it a $385 billion market cap. I think it's worth more than that. So I'm still optimistic. And why am I hesitating here? What is that issue that I have? And the issue is the market. We've seen it. The market can just be relentless. And when it turns on some of these higher valuation, it's still a relatively high valuation, even though it's come down here. It still is a relatively high valuation. And so I think that that's the piece. I'm not trying to get cute. I'm just making the point that we probably are going to get to a point where numbers are coming down. We've referred to this earnings period more broadly for across tech is going to be something that's messy is the word we've used. And that means that guidance is going to be messy. And so even if, let's say Tesla does just fine for the December quarter and the outlook for March is fine. If the other companies are lowering guidance, people will say it's just a function of time before Tesla has to do that. And then the stock probably goes down in that. So I think that you really need to, if you're owning it here, you really need to own it for 2024 and beyond.
Gene, for years you talked about Apple, not getting love for like its valuation. It traded at extremely low valuation, and it got the big price increase, stock split, whatnot, a runaway bull market. And Dennis, who's been a long-term owner of the stock, just kind of said, I don't think it can keep up at its current multiple. And I know we've asked you this before. I think Dennis maybe has his hedge up around 155. I mean, you've argued for a long time that it should have a higher multiple. It's got the higher multiple. Is it now time for it to come back down to do a reset of the multiple? Or can they just keep cranking out the billions and, the amazing earnings performance without really new products?
Well, they can crank 10%, close to 10% growth with buybacks in terms of earnings growth. That's going to be good for the stock. I think the reason what can cause this to have further multiple expansion, that's not going to expand the multiple to do just keep growing earnings at 5 to 10%, is if they can really kind of step up growth again. And right now growth is, call it mid-single digits, high mid-single digits. And so, I think if you look at probably the person who does the best work on Apple is Mark Gurman from Bloomberg. And he's just been, if you really read what his work is suggesting, he's neither bullish or bearish. He's just reporting what the company is doing. The piece that I pick up on is just the consistency around what they want to do in the car. And I think that I'm still not willing to say that they're going to make a car, but we definitely know they're trying to make a car. And that's a piece that initially the reaction probably from investors is going to be they're going to have a negative impact on earnings, and that's negative. And then probably shortly after they'll realize that this helps solve the growth problem. Put into perspective, if they can get 5% market share, they can double their revenue. I mean, it's a massive 5% auto market share, they can double their revenue. So they have a huge opportunity there. I think this mixed reality headset is nice, but it's not probably going to change their growth trajectory next year. So, Joe, I think when you put it all together, I still think this is just a world-class company. They incredibly well run. I mean, not only the ability to navigate what's happened with the supply chain, but political wins. I mean, part of the reason why China is loosening some of their COVID restrictions, I believe, is Apple's influence that came through Foxconn, that went up to the Chinese Congress. And so this company has a lot of power. I think they're going to be in a great spot. We're dependent on their products. And I think they're going to get into new categories in the years to come.
Okay. All right. Let's move on to a couple of other tech stocks before you let you go. I know you'd been on the Meta train, and maybe perhaps like a lot of people, a little bit early here. It's had a nice rebound. I think people were just looking in the rally, like, what could I buy? What's cheap? What's come in? Meta, just give us your thoughts on that. I don't know if you have individual ratings or price targets, but we're one of the most beaten down stocks of 2022. I'm not saying a big winner, but is this one that you're looking at with perhaps good upside?
We are. It's one of our larger positions, and it's not just because it's been beaten up and it's a big company that's been beaten up. It's because I think the penalty that they've been received, that they've been delivered for their investment in the metaverse, I think has been too much. I think that the metaverse is something that is going to ultimately become how we interact with machines, computers, our new devices is going to be in the metaverse. I think they will get some validation around, Zuckerberg will get some validation around the metaverse with Apple and their mixed reality headset. Spoiler alert, Apple will not use the phrase metaverse. They don't like talking about it as the metaverse, but it's all the same. Investors will be able to connect those dots. So we're optimistic that metaverse is going to become something, but the reason I think the biggest benefit is at the deal conference, the New York Times deal conference earlier in December, Zuckerberg made a comment about their core businesses being solid. And I think that there's this 2% engagement growth, year-over-year engagement growth that they've been delivering on consistently for years, I think is continuing. And I think as long as their engagement is continuing, this is in the face of TikTok, as long as their engagement is continuing, I think that the stock is probably well positioned this year. This is one that, you heard me talk about Tesla and Apple, and been talking about longer term, 2024 kind of beyond. And I think in the case of Meta, if they can continue just to show their core business is strong, I think that that's positive in the near term.
Okay, let's just finish up with the other two big boys here. I guess we could leave Microsoft out of this one, but did you ever think you'd see Google or Amazon at the prices that you're I'm seeing them at now? Google with that, with the big deal. I know for the NFL football. Have they lost their way? Are they trying to find a new way? Give us your expectations for Google and their latest move, and then touch on Amazon. I guess it just the cloud earnings, I guess, just didn't were not enough to make up for that over expansion during the pandemic. So just give us the thoughts on those two stocks, and we'll let you go.
Love it. In terms of Google, we do own Google. I think that there's a case where this still continues to be we just have always described this as the oxygen of the internet. We just can't live without it. And I think that they have pricing leverage around search. I think what they're doing around NFL and around other content is really important, because these are high engagement properties that they can apply better ad targeting to. And I still think that it's incredibly obtuse. It is obtuse. It is not very effective the way a lot of real-time TV by appointment. It's rare today. NFL is one of the few ones that's out there. They just don't have the right targeting. Google can help apply that to it. So we're optimistic on that front. Amazon, we do own Amazon. This is one that we're bracing for this impact on the consumer. Amazon's going to feel it. I think that's the reason probably why it is where it is. But I think, again, this is one we're looking out further 2024, is that it's still really hard to compete with what they have been doing. So we acknowledge there's some near-term headwinds. This can get dicey in the near term with Amazon, but I think long-term it's still a great business.
All right, I'm going to sneak one more in here, and it's not a stock, but I know we've talked about Bitcoin, over the years, and just your outlook for that, the digital currency, just hanging out here, just under 17,000, trying to get through the whole SBF fiasco here. Do you have any outlook for Bitcoin in 2023 and beyond? And you could take a big pass on that one too.
Yeah, we were really involved until about 6 months ago, and then we just kind of stepped back from it. Don't have a good update on that. We'll be back. We think Bitcoin's going to be around. We still believe in crypto. We just not spend any time there.
Okay, we've been on the line with Gene Munster. He's the managing partner of Loup Ventures. Wrapping up 2022 for us, a year that he's been cautious, and seeing when he'll be deploying his assets here in 2023. Gene, as always, fantastic to have you on. We'll be talking to you in the new year.
Thanks, everybody. See you.
All right. So there we go. We got through that first hour and 25 minutes here. We didn't do a lot to help the market, Mitch. Were we talking too bearish, Mitch? The SPOOs now are only up barely 4 handles here at 38.74. Mitch, what are you seeing out there?
Well, it looks like we're already leaking, and so I don't know if that's a good thing or bad thing, right? You guys can look at it any way. At least I was looking for a little leak towards the open. Looks like we already got that, right? We're close towards the close there from Friday. Close I have at 382.91. All right, and we're at 383.06. So we're looking at Friday's range here, getting ready towards the open here. We'll see what happens if the SPY comes back down and takes that out. What are important levels that you'll be looking for today on the SPY overall, Joel?
Well, I do my levels, versus the S&Ps. And so first things first, the close. I mean, we have not seen that yet. And we are now, you can look at your quote monitor and say, we're up 2 points at 71.75, right? But we're almost 30 handles off the high, right? So I mean, at this point with the downward momentum, I haven't seen what the imbalances are or anything, but we're going to test unchanged here, right? And we're going to test the close. So one thing I like to look to, through the, that first few minutes is, do you get some good follow through the pre-market low? And the pre-market low, we're 2 handles above that pre-market low at 38.70. You could pull up for what the spiders is on it. One thing that kind of looking at the levels over the weekend, and definitely had a lot of time over the weekend to do it. And the reason I said at the top of the show is that there's a setup here. Like if the Bulls or the Bears want to take control, I have daily numbers lining up with weekly numbers, and weekly numbers lining up with quarterly numbers, and that doesn't happen very often. That really does the way that I do, because especially for the quarter, we're coming to an end of a quarter, right? So Friday, that's the last trading day of the year. Friday, I will calculate the numbers from the last quarter, which hasn't been that bad, right, since the October low. But just overall, for me, and I just, I could look at the 3 numbers, and they're probably within 20 points from each other, but I'm just going to make it nice and simple. 38.50. That's where everything kind of comes together. Now that's 22 handles from here, right? So if I was playing it short to the pre-market low, I'd be looking at that area. But if especially on today, with a day like this, if we get down to that level and we don't hold, then I think Santa Claus, he already came to town. We have an excellent shot at going down and taking out the low from last week. I think you see your continued selling. If in fact we could hold anywhere in that area, between 38.50, 38.70, and I'm talking about for the whole day, right? I'm not just talking for the first, 15 minutes, for the first half hour, and then get back over, 3,900. And then if you're really looking for the rally into the end of the year, really looking for Santa Claus to, make up for everything that happened, you got to take out last week's high. And that's a double top, just under 39.20. So, I want to give the market the benefit of the doubt here, and saying, we're opening above support. But what you have to do, obviously, in this market, if anything you've learned in 2022 is, there's always opportunities. Yeah, there's good support. There's opportunities to buy. But when that support doesn't hold, you got to take things to the other side. So that's my early setup. I'm watching Love here continue to sink, down $1.74 here, trading at the lows of the pre-market session. Now, this is a big, thick stock. You do have a daily low. Your October 26 low was 34.31. And
which one are you talking about, Joel?
Love, LUV.
Love. LUV, the love. Not getting the love,
and
right?
This is just, Love not getting the love. 275,000 shares have traded, 280,000 shares. I mean, if you think this is a thick stock, the daily volume of it, I guess that's pretty good volume. But wouldn't it be shorting it, down $1.67? And if I happen to catch a short or look in long-term position, I take a look at that pre-market low, as that coincides nicely with the daily low at 34. Excuse me. It's actually 34.31. All right, we're open for business here. We're still seeing some green, Mitch. What you got on your radar?
All right. Was going to take a second to pull up my stock odds, but I'll pull that down for a little bit later. We need Rob in here. Rob's will be coming at the end of the show today. Definitely need to go ahead and set up my stock odds to be looking at that. But let's get towards the open here. Oil is what I'm looking at for the move up here. 930 just hit here. Looking for XOM starting to move here. Of course, I might take a trade or two here. We'll see what happens.
Okay. Well,
But
let us know.
ExxonMobil starting to get a little bit of a move here right out the gates. A lot of times I look at change percentage from the open, right? Energy leading us, consumer defensive, and then healthcare right now. What's in the red out the open? Technology taking a hit down there. And if I look at what industry is getting hit there, semiconductors getting hit down about 0.84% on the day. So be careful there with the semis. I'll go to the leaders right now to kind of show us where it's going down there. NVIDIA coming down hard out the gates now down towards 150 there. Just broke the 150, now in the 149 handle. We'll see what happens there. TSM coming down. Will it fill in the gap? That's what I've been looking for on TSM. Almost filled the gap last week. We're really close to there. I think we fill in the gap today. We'll see what happens there. TSM, AMD struggling. Looks like semis out the gate starting to struggle here.
Yeah, that they didn't even blink at that pre-market low. We just had all that fluff up there on the opening, and it didn't even hold for 1 minute. You took out the pre-market low. Now we're starting to look into that area, right, where I talked about where you had the confluence with the numbers. So yet to catch a bid here. So still concentrating. I believe the weekly number that I was looking at comes in at 59.25. That hasn't come in yet. I would just alert our XOM traders. I do see that you did have a nice open here, and we talked about this setup last week, right? When a stock makes a high, a new all-time high, and has a meaningful retreat, what do you look at? You look at like the rebound, right? Is it going to get half of this move back, which it's currently doing? That comes closer into the 109 area, right? So now it's like, well, I didn't get to sell on the rip up. This is a little bit of a pop. I have no daily high in here really to refer to. So I'd say as long as we still hold above 109, current high 109.55, under 109, which we're falling at here, I'd say it might be you might have seen that early morning pop, higher open, and hit the high at 109.55. But right now, battling to stay at the 50%. That's a 109 area. Your next high, I don't think we'll see 111.36 today. Also, when you're trading this, you got to be looking at the crude oil market, and yeah, the crude is up 40 cents. That's a positive. But you made a high at 81.06, and you are a buck off that high. Still seems like we do have continued selling pressure here. Current low 61.75. So the bulls have not yet made it an attempt here to get us back under unchanged, right under that closing price here at I believe it was at 69.75. We did sure talk a lot about Tesla this morning, right? And when you're looking at Tesla, people were asking last week about the capitulation move, right? Like, the puke. I mean, a $7, $8, $9 lower open. I mean, you could construe that as you want. When we first came on the show, there was a nibbler there at 115.5, 160, whether they were short, whether they were trying to cover some puts or just getting a jump on it. So right now, off the open, leaning on that pre-market low, maybe we'll get a gap fill here in Tesla. So that pre-market support is holding up for now. What if you're a gap trader? Yesterday's range was 121.02. The closing price 123.15. S&P's certainly not helping it out. Mitch, what are you seeing in Tesla?
All right, Tesla, big jump right out the gates here. I have it on a 3-minute, can go to a 5 or 15, but you guys can see that. That's jumping towards 120. We'll look for some pullback. SPY coming down. That's looking weak. I'm looking for a VWAP rejection on Apple. I'll show you guys that chart here on the right-hand side here. Apple coming back here towards the VWAP. We'll see if it gets towards that. Looking at it right now, that'd be that move into the 131s here. VWAP around 130.91. Already hit it here. So would have to jump in here. If I can get it back closer towards 131 is what I'm looking for. SPY making new lows here. Tesla pulling back here. I will look for the VWAP to hold there. That's 118.20s. Could look for that. Of course, Tesla completely oversold. Could have a bounce. Doesn't mean that it's completely turning around, but definitely having a bounce today. As you see, Apple rejected that VWAP. That's my style of trade. I like those VWAP. They're called VWAP fades. Where you get down action out the gates. Big important level underneath it, right? On the daily candles, right? If we start breaking the 130s, 129.60s,
Yeah, there's
very important.
I know.
So the SPY action also here is telling me maybe look for that Apple cut down, right? Look at the SPY out the gates, down, down, down.
Straight
down.
down.
Tesla just pulled below that, now coming back towards that kind of pre-market range. I kind of like that level here as long as this kind of resistance starts to hold 117.50 area. We'll see if it gets back up through 119.50. But SPY now down to 381, hard hit on the downside.
Straight down.
Yep. And Amazon,
Yep, straight
down. Google, straight down, right? The big boys, when we get taken down by the big boys, have a tendency of dragging. And a stock like that was strong. Look how NVIDIA looks so weak now as a semiconductor is still getting flushed. Micron getting hit, AMD getting hit. Big hits there in the markets. Definitely Apple would have been a nice short off of that. That's where I would be taking some profits right now on the low of that 130.45.
Yeah.
Looking for the cut down through the 130s now as we start really breaking down. Look at that AMD takedown.
Yeah, what's going on with AMD? Just the real quick on the Apple, you know, it has two lows in this area. You got to give it down to that monthly low, I believe, is 129.04. This one I've been concerned about since you took out that 134.5 level. It spent one day above it on the rebound and been under pressure here. So we did get to that lower band of the support area I talked about. 38.49 is the current low. Getting a little bit of a bounce right here is where the bulls have to step up because Friday's low is, I don't know, I know Friday was a long time ago, but 21.25 was Friday's low. That's another 30 handle drop. That'd be put some hurt into the market. I haven't looked at it. Let's take a look at AMD, how that is more. And come on, AMD. Let's see here. Down $1.10. I mean, it's areas of possible
Joel, I'm gonna interrupt you
here for AMD.
I'm going to interrupt you just to,
you have not hit Friday's low, nor what do you got?
No, you're starting to lag out a little bit there. Just want to make sure you know that you're breaking up a little bit. Just probably doing a little bit too much in the background there. Apple bouncing off the 130.14 level. That's probably where I would have taken the full profits. Could look for the VWAP bounce now here to come back. We'll look to see if the SPY can find a little bounce and get back to the VWAP. We just bounced from a low of 130.82. We'll look to see if we get back there.
Okay.
Or is it just going to be a slow leak right now? But definitely Apple hit the major level 130.14. I had that already drawn out there. Now we'll look to see if we actually get through those kind of all-time lows on the 52-week, which is 129.04. If you want to be exact, we'll see if we come back down and take it out. Not a bad outlook there. Let's go to oil XOM now starting to come back here. I like this outlook. It just got in the bounce. It's back above VWAP on XOM. This is a 3-minute. Let's go to the 5. We'll look to see if it takes out the 109.55 on the upside there.
Yep. That was the high, 109.55. Did hold that 50% area. Sorry, I opened up another program. I looked up and I had this other program open, and I'm like, how the heck did I open that? That was the problem, though. It looks like the bulls are digging their teeth in here a little bit in the mid 38.50 handle. Current low 38.49. Now you're starting to get a little bit of a bounce. I mean, only a meaningful bounce would be until you got back over unchanged there at 69.75. Tesla didn't quite get that gap fill. 1967 is the high. The AMD. Let's take a look at that. That hasn't, still kind of a quiet range here. You did not take out that low from Friday. Actually, there's a real good area for you AMD traders. If the downward momentum continues, there's a pair of lows from, that would be Thursday and Friday. That's between, right, let's call it 62.50. That spots the lows from Thursday and Friday, 62.26 and 62.72. Current low, 63.30. Nvidia, that got punished the other day, continues to get punished. Maybe hold out for a gap fill in Nvidia. I don't know if that was off earnings or that was just a market rally day, but if you come down just a little bit more, I see a gap fill in Nvidia. 142.11 was your high on November 9th.
Yeah, it looks like that was one hell of a bull trap there on Tesla as you're back down towards 116, got to a high on the day of 119.67. This is what I mean, and I think what Dennis meant earlier today, that you got to be careful if you are shorting these names, because let's say if you were short out the gates there, you got to pop right into it. So you got to understand that the volatility in this stock is massive. You guys can use maybe an ATR or something to kind of tell you the volatility, but big move there on Tesla. We'll see if it takes out the lows on the pre-market. We got what, 115.64, 116.65, all near the same level. We'll look to see if we take it out.
1583 was your low in the regular session, right? And then we had mentioned where the buyers had stepped up. Let me pull up my Tesla chart here. And
just knockdown. There you go.
Just another leg lower. There it goes. It's right on the pre-market low here. The bulls better figure something out here. Your pre-market low that comes in at 1561. You just hit 1575. If you're a Tesla, you pick this up, you want this thing back over 116. You want it bid back over 116. Next monthly low, like I told you, folks, that doesn't come in until under 110. That next monthly low comes in at 109.37. 109.96 if you're really holding out. But Tesla, break it down, making new lows, following the S&P lower. Now we have Apple in the 129 handle. Getting no help from Apple. Yep, get no help from Apple. Where are we at? Look at Apple, right on last week's low. Still on Friday's low here, 129.64. Current low 129.90. So looking for that to get above, just like Tesla needs to get back above a 116 here. Apple needs to establish some kind of bid above 130. Spoo's trying here. I guess they're not going down as much, but certainly not distancing ourselves from that low at 38.49. What else do we have coming out of the chat, Mitch?
All right, catching up with that. How we doing out there, team? Jonathan in the chat. It's good to see you guys all. If you guys have tickers that you guys are catching movement, go ahead and throw it up in the chat. We'll make sure that we cover them here. I did see someone wanted to take a look into Merck. So if you wanted to do that for us, Joel, you can go ahead and do so. Looks like Apple. Oh, that would have been a nice short out the gates today. I'm not going to take any trades, team, just because I'm sharing my screen here, and I don't want to just completely look away for us. So we'll just focus on bringing you guys the stocks. Let's go to that Merck chart. What do you think about this?
Yeah. Oh, boy. I mean, I bought this one back sometime, bought it bad in early 22. I believe it was this old Dipsy Doodle here, right in this, was that in 22? I don't know. I bought it and it went, I think it was like 85, 86. I can't remember. And it went straight down. Really not much to say here, right? You're in an all-time high. You're at 112.43. That was a new all-time high in the stock. The only thing I can see here is that, maybe there's some paper at 112.50. Now, when I'm talking about paper, what I'm talking about is size in the New York book, right? This is saying, hey, you know what? The stock has never been up here. This is my target. This is where I'm peeling back. I have stock up here. Come and get me. So your high frequency traders, also some of your institutional traders can use that level, right? Trade against that level. because they have a covered short, right? They know that they have to fulfill that order at 112.50. So that's the only thing I'm thinking about for Merck is it pulled back, and now the fact that it's pulled back from the all-time high. S&P just relentless sellers in here, just made a new low for the session. What my short-term focus here would be for the all-time closing high. That was made on Friday at 111.86. So we have distanced ourselves from that. Not a lot, but now I think you could see your 112.5 seller come down, be a little bit more aggressive here at 112, trading on the lows of the session. Really no daily support to lean on until we get to Friday's low at 110.87. Another round of sellers. Did we have something come in at 10:45?
No, 9:45. Usually we get that reversal, right? I think traders were looking for that type of reversal there. 9:45, 10 a.m. We usually get a little bit of some pop back if we've been kind of trending in one direction. You guys can see we went sideways right there at 9:45. There's a reason why I feel like some traders were starting to play that reversal style play. It didn't work out here. But another thing is it could just make another wick type of action and come right back up. We'll see if it actually continues down through 10 a.m. That's usually what I look for, is a 9:45 move continuing through the 10 a.m. If that trend can continue all the way through 10, I usually feel like it can stick for the day. Of course, power hour at the end of the day could always turn things around, but we'll see if it turns around in the next 15 minutes. That's why I think it's so important to use like maybe your 5 minutes or your 15 minutes as you start getting to this third candle, right? The opening orb traders look for the range to be broken down and then start trading in that direction. That's another thing that you see a lot. The orb traders, the opening range kind of breakdowns. We'll see what happens there. I am seeing some oil plays not looking too bad right now. Oil just pulling back there. One stock that I don't have, but I've been keeping a close eye on is Halliburton. I just did a pullback towards yesterday's range and kind of the pre-market range. We'll see if it bounces back towards 39.50. Oil overall, we'll just look at USO pulling back here from the gates. And let's just do a sector outlook as we'll go ahead and get to our next interview in just a couple of seconds here. Let me just take a look here. Basic materials leading us on the day. Majority of the sectors in the red from the open. Only one sector in the green from the open. That should tell you a lot. Basic materials, what's doing well there? Copper, FCX having a good day. SCCO, take a look at those. Silver trade doing well today. PAAS, not a bad move there. AG, MAG. You guys can look at some silver names. Gold up today. Aluminum up. And steel not looking too bad. Even coal. Well, you guys know I always talk about BTU. Is Santa bringing some coal today? Big level above it towards the 30. Can we recover that coming back towards the highs? Next high on the daily chart has us towards 30.32s. Couple highs into that 30.50 area. We'll see if we get back into the 30s and clear 30.50 today. Getting out of basic materials, energy slightly into the red. What's dragging us? Technology dragging us. Look at our leaders. Apple now down to 129.50 as we start breaking through there. Remember, we looked at the 52-week low earlier today, and that 52-week low is towards a low of 129.04. Will we crack it there? Doesn't look good on Apple today. Microsoft not looking good. Google, TSM, NVIDIA, Meta, not looking good there. And Meta, another rejection of this trendline breakout. That looks good for me for a short now. But of course, you guys make your own investment decisions. Hope you guys enjoyed our outlook into the market today and everything that we have for you.
Okay.
All right. I'm going to go ahead and put myself in the background as we'll go ahead and bring on our next guest. You guys ready to keep it going, team? Let us know in the chat. Hit the thumbs up. Let's keep going. I'm going to go ahead and get towards the background. Joel, you want to do the introduction? I'll let you take
Michael Pachter. Yeah, are you going to do the
Of course, I got it. We'll get it going here. Let's go ahead. Let's bring on Michael Pachter here, equity analyst, Wedbush Securities. Let's get it going here.
Good morning, Michael.
Morning, Joel.
How you doing here? Thanks for getting up nice and early on this Tuesday here. Santa Claus, he came to town. It looks like he decided to leave pretty quickly. I just want to go back. I do have some individual questions to ask you about the merger and also some of the top stocks that you follow. But one question I've asked my guests a lot this year is like, like if you had to do 2022 again, what mistake did you make? What did you underestimate? Revisionist history here. What do you feel like in your analysis? I know you got some stuff right, you got some stuff wrong. What's just one thing you wish you would have concentrated more on?
Cash flow. Cash flow matters. So the companies that generate positive cash flow, while most of the tech stocks are down anyway, they hung in better. And the guys that burn cash are dragging down at all-time lows, and there looks like no bottom in sight. So I think that when the market started to crack, and clearly that kind of correlated to interest rate increases, I think the market made the call that cash matters, and the potential to have to hit capital markets again is bad. So anybody who's burning cash, clearly every day they're one step closer to needing to raise more capital, and those stocks have just gotten destroyed. So again, fortunately, I don't think very many people listen to me. I think people, they take my commentary as one piece of the puzzle, and then they make their own decisions. But a lot of people lost a lot of money because they chased growth stocks that may be growing top line, but they certainly are not growing earnings.
You've been around, you've been a veteran of the market. You saw what happened in the early 2000s. Just, take your analysis from that. What's going through now? People try and have that optimistic view. I mean, I think we broke the mantra of, new all-time highs right around the corner. Just drawing parallels from those two, from that earlier time period to now. It's just the generational value trade overtaking tech, or it's just a little mean reversion, and your tech is going to be back, maybe not in 2023, but beyond that.
I mean, I think that the difference between now and the early 2000s is that there was skepticism about the business models back in the early 2000s. And, some guys emerged, like Amazon turned out to be a pretty good business model, but, there was still skepticism. And if you remember, even in like 2011, people were skeptical that Facebook could transition to mobile. So there are tech companies that are going to jump out and stand out from the pack. Most of the stuff I cover is either entertainment, which is pretty robust, it tends to rebound pretty strongly, or it's kind of interesting tech that we need. And I'd say in particular, guys like Unity, AppLovin, they deliver ads to mobile gamers, and mobile gamers are half of the global population. So it's the biggest audience, the greatest number of eyeballs, the largest amount of engagement in any consumption of anything. And advertisers have to find them. They're going to find them. So, even though those companies are at their 52-week lows, I kind of like them. I think that those guys recover quicker. And AppLovin, as it happens, is generating positive free cash flow. So I think that one's really interesting right now.
Okay. All right. Let's talk to the ongoing merger here between ATVI and Microsoft, Activision. You came on a few months ago and were pretty firm in your convictions, right? That the deal was going to go through. We've heard some different opinions coming out of the EU here. It's still a widespread between the actual takeout price. I know Mr. Buffett is in the camp as well that it's going. Two questions here, just current appraisal of the deal, and then also the risk reward ratio here, right? If the deal doesn't go through, where's the potential downside for ATVI?
The deal's going through. It's just a question of when. And the bet that it will break up is not a bet on the law. It's a bet on Microsoft's resolve to get this thing done. So the way to handicap it is to assess how stupid the regulators can be and how badly they're willing to be embarrassed and lose. They have a loser on the law. And somebody sent me an article that Lena Khan, who's chairman of the FTC, chairperson, the FTC, wrote, saying we're not influenced by ESG, so we're not influenced. The veiled language was, we're not influenced that Microsoft will be a better employer for women and minorities than Activision has been. We care about the law. Well, guess what? The law is not on her side. So if she cares about the law, she's going to walk away from this challenge because she's going to lose. And I think that really the market is saying these regulators are irrational and they're playing for political points. I think both of those statements are true. I think that they are irrational. They're playing for points, but I think that they win points by being first to the table to achieve concessions for Microsoft in the deal. So I think that the FTC accelerated the timeline into the first week in December and filed their challenge, their complaint in the administrative law court, because they really want to settle first and beat the EU to the punch. The law in all three jurisdictions that are challenging this deal is the same. Does the combination result in less competition for consumers? The answer to that question is no, it does not. So that's a bunch of negatives. Competition isn't worse. What ends up happening is that Microsoft gaining access to Activision content creates a new way to play that content by paying a low price subscription and not being required to buy a console. So consumers spend less to get the same content. It's sort of like saying, is Netflix bad, for competition when they provide all you can consume for $15.49 a month? Well, no, because $15.49 is cheaper than the lowest possible cable bill. You're getting plenty of content for less money. So unfortunately for Lena Khan, the FTC approved two mergers under the Biden administration, the Warner Brothers Discovery merger and the Amazon MGM merger, both in video streaming, and nobody raised any questions about whether that would be anti-competitive. She is bound by that precedent. I know our Supreme Court doesn't think they are, but she's bound by that precedent. She has a slam dunk loser in court. So I truly don't think this ever gets to trial. I think the FTC made their filing. Microsoft responds. The judge asks them if they can achieve a common ground, and Microsoft will accept any concessions that the FTC asks for, which is going to be, keep the content available for PlayStation, and they're going to do that. So I think the deal closes probably at the latest March 1st. So about $20 upside in, what is that, 3 months? So not even, 2 months. I think investors should be all over that. You've got, 25% upside in 2 months. Go for it.
And then the downside, if will the stock go back to where
I have a 425 estimate for Activision for 2023. After the deal breaks, if it were to break, Activision would have around $15 a share in cash. So you have a $75 stock with 15 in cash. The enterprise value is about 60. Enterprise value net of cash about 60. So it's trading below 15 times earnings, and the market's trading above that. This is not a worse than market performer. This is at worst a GDP growth story. At best, more like a 7% top line story and about 10% bottom line. So I think investors will pay 16, 17 times. And I think after a week or so, the stock actually trades above 75. So downside, nil, maybe $2, $3 for a week while the ARBs unwind their position, and then fundamental investors rush in. Keep in mind that there are plenty of fundamental institutions that aren't allowed to own ARB plays. So they'll be back. And they're the ones that are calling me, asking me if I think they should be taking positions if the deal breaks. So I think the demand will be immense. I think the stock ends up going up on a break.
And then if the deal's consummated, Microsoft has had a really rough year here. I know that they've done some of their big transactions before with LinkedIn. How long, if in fact the deal goes through, how long Apple or Microsoft, over $100 from its all-time high, how long you think, it will be able to filter through and help to the bottom line for Microsoft?
Well, they have a pretty long playbook, a pretty long-term playbook. I don't think they actually care about this decade and about immediate results. That's
Mm.
why they're willing to give concessions to PlayStation and keep Activision content, on other consoles. They offered up to Nintendo as well for the next, 7 years or so. But I do think you're going to see a pretty rapid spike in subscriptions to Game Pass. And again, I don't cover Microsoft, so I don't know what investors are going to value. It turns the subscription story from merely Microsoft Office subscriptions to Office plus Game Pass. I think what you're going to see is Game Pass looking a lot like Disney Plus, where they're going to go from 25 million current subscribers to 50, 75, 100. Again, it's hard for me to tell you that the market's going to slap $500 billion of market cap on the stock for that, but they certainly are going to think of that as a positive. And probably most importantly, Microsoft's profitable at that level. A lot of people question whether they get a return on the Activision assets. They're going to keep selling Call of Duty. They're going to keep making Candy Crush. So, they're going to have plenty of regular profit from regular channels. They're just going to augment that by expanding the Game Pass channel, the streaming subscription, to people who don't want to buy a console. And imagine if you play one game a year, you would never buy a console in one game. But if you can, for $15 a month, you get access to 200 games, including Call of Duty, you might. And if that one game is Call of Duty, then of course you will. So I think that you're going to see them kind of sneak up on people with this Game Pass subscription, much as Netflix snuck up on people with its subscription service in the early 2010s. And I think Microsoft's going to actually end up being a lot like Netflix.
All right, we had you on a few months ago, and I remember talking with you about Netflix, and I think it was trading maybe the 230. I mean, it was well under 250. I know 250 was a big resistance area that I was looking at, and maybe I'm off here a little bit, but maybe you had a 280 price target on, right? And it far exceeded that, got over 300. Now, I know there's been some news last week that brought us down off its keister. Also, along with the markets, the overall decline in the markets. We had Mark Chaikin on last week, and he gave us like his one stock of the year on the downside. That was Tesla. I know I'm not going to talk about that, but according to his work and his power gauges, one of his top stocks for 2023 was Netflix. Now, it's you had the rating. I know you were bearish on it for a long time. You flipped at the right time. It got to move up. Are you going to go to the sidelines now and call it a day, or it could be what we heard from Mr. Chaikin could be one of the bright spots in the market in 2023.
It's for a short-term trade for the next 6 months. It's one of my favorite ideas. We have a 325 price target, and to be honest with you, it's kind of a cash flow forecast number. And so one more quarter of reports, if they exceed what I expect, it's easy for me to take my target up. If they miss, then obviously they'll go down, and I'll take my target down. So let's see what they do on cash flow. But I think that what people don't yet appreciate is that the ad-supported tier that they introduced in November is a big deal. And it's not a big deal because they get a lot of brand new subscribers who never tried Netflix, although there is some of that, of course. It's a big deal because they have big churn, and they stopped giving us churn numbers, in something like 2015 or 16. So we haven't seen that number in 6-7 years. But the number used to be somewhere between 3 and 4% of their total subscriber base per month. So they lost between 35 and 50% of their total subscriber base every year. Now, it's not the same people all the time, so people would quit and come back, quit and come back. They're giving you an opportunity now to quit at $15.49 and sign up at $7.99 and watch some ads. And I think that's pretty compelling, because the people who care enough, who are cheap enough to have to worry about whether they can pay the Netflix subscription every month, they're going to find that appealing. The full year costs you under $100, and you instead of trying to game the system and trading in and out. So I think what you're going to see, and we're going to find out this quarter, we're going to find out like mid-January, is that churn subsided. If you think about net subscriber additions, that's the sum of all the new subscribers who sign up minus all the people who quit. If the number of people who quit declines, then net subscriber additions is going to be big, especially in the US. So if they beat expectations for 1 or 2 quarters, and I think that they will, I think this stock's a rocket ship. So I love it if I'm right. We have to see if I'm right. And then they've got the other second prong of their strategy. They're going to crack down on password sharing. That can work both ways. That can anger people like me who have kids in college and share my password because they actually still live with me and I pay all their bills. And we'll see how they deal with that. Although my kids are finally seniors, so maybe they'll be off the dime in a little bit, and I'll let them get their own subscriptions.
Yeah, I mean, one thing that I would say here is that I don't see the password sharing going away, Michael. Is that what you see? Do you see any time that going away?
I think that the right solution for this is to say that 1549 will allow you to watch Netflix in one location at a time, and in a week or something. And if they see a second location, they'll ping you. Are you in a hotel room? The problem is, I travel, my wife doesn't. So am I allowed to watch in a hotel room while my wife watches at home?
Exactly.
But again, the ultimate solution is charge us an extra $2 per account or something, and let me have my family members on, and they can modestly lift. I do this with Spotify. Like I had a $9.99 Spotify subscription, and my kids started driving, and so we changed it at the time to $14.99. I think now it's $16.99 family, and I'm happy to pay that. And everybody uses it, and Spotify doesn't care where we are, and they don't care where we live. So Netflix really just needs to add a family subscription, maybe $19.99, and the honest people will pay that. And we'll stop password sharing, but we'll see how they implement. They aren't always the smartest guys in how they deal with consumers, so we'll see.
Yeah, one thing is I just feel like there's so many other platforms that have an ability to read when you're using that duplicate license, right? It seems like Netflix just can't get that right. Another thing for me on Netflix, though, it seems like their mentality is also shifting. They don't necessarily just want to be focused on growth anymore. They want to be focused on profitability, right? And I think that
crazy, huh?
Yeah, right. Can you believe that? And they even mentioned how they don't want to be giving out their subscriber numbers, right? They don't want to be focusing on that. So as this stock turns from a growth to a value play, what do you see in the value area? Where does the cash flow here? Does it make sense at this valuation?
There's a flywheel effect. So there is a point for any media company where they create enough content to serve all their customers, and as customers grow beyond that break-even level, it's all incremental profit. So they can get there. And owned content they don't pay incremental royalties on. Obviously, licensed content they do. So they've been making that shift for a dozen years. And the question is just, have they reached that inflection point? Where they're getting smarter is that they're canceling shows more rapidly than they have in the past. They're greenlighting lower price movies, and they certainly have several expensive ones still in the works, like Glass Onion. But they're getting smarter about spend. They're shifting content production to Korea, which is smart. They're shifting to really low cost reality type shows like the Great British Baking Show. So I think that you're seeing their actions kind of be consistent with their goal to be profitable. And yes, I think that as they grow, the incremental subscriber is pure profit. I also think that the ad-supported business is going to ultimately be a winner. They kind of stumbled out of the gates, as Joel mentioned, but I think that they'll end up making as much on an ad-supported customer as they do on a subscriber, and the ad-supported customer will be less likely to churn out. So I think they're kind of doing everything right, with the possible exception of gaming. I still think they're tilting at windmills there. I don't think they really have a strategy there yet that's going to work.
All right. Well, thank you for joining us today, Michael Pachter-Equity Analyst at Wedbush Securities, always covering everything in the gaming area, in tech, appreciate you coming on today and joining us on our special show here for 2023. We'll definitely see you. Have a happy new year, Michael,
guys
and I
too.
hope you have
Happy
a
New
good
Year.
one. Definitely. All right, let's go ahead. Let's take a look into the markets. What are you seeing out there, Joel, in the SPY?
Well, SPY, S&P, we continued lower, 37 and a quarter. Not much there for you folks. My level of concern on the downside was that low from Friday, 21 and a quarter. Still haven't reached that, but definitely have been making lower lows on the dailies here. I don't think let me pull up the 15-minute here chart. Kind of, the bears were out there prepared to sell at the just about anywhere, and the Bulls haven't made their stand yet. Still comfortably above the low from last week when we snuck under 3,800. That wasn't for long. That low came in, I believe, at 38.88 and a quarter. So the only thing standing between 37.88 and a half was the low from last Thursday. The only thing standing in between that is your low from Friday at 21 and a quarter. I guess if you want to try and make a positive spin on this here, you do have from Thursday, you do have a higher low on Friday and now a higher low on Tuesday, but that's really trying to make it positive on the upside. We talked I've been talking over the last couple of weeks here about the 3,900 and that psychological level and clearing that. Well, you had to be up overnight to get that 3,900.50 that stands at your pre-market high, and then your intraday high that comes in well below that, 18 handles below that at 38.72. Apple, people are mentioning making a new 52-week low.
Yep.
Still in that area, right? 129.04, I believe, was your June low. So cannot establish a bid in the 129 handle yet. Current low coming in at 120. Where's the current low? 128.72. But if you've been waiting to buy Apple at the 52-week low, here it is. You have that opportunity. 128.72. SPOOs are now 10 handles. They're trying to get to be 10 handles above that intraday low at 37 and a quarter. Next stopping point getting above 38.50. And Tesla did take out that pre-market low. That still now is acting as a little bit of resistance. 114.63 is your current low. That's down over $8.
What a trap today in that Tesla and Apple. Nice short there. Definitely missed that one. That was probably the stock that I was looking to short into. Now we're starting to cut through those lows there. We already went through that 129. Let's see if we recover that 129.04, which was the 52-week low, and bounce back towards the VWAP. Right now, the SPY is just leaking. We need to see if it could actually make a move to VWAP, which is 381.37 right now. We'll see if we even get a bounce. Right now, I do see some sideways action on the 5. So let's see what happens here towards 10:30. But it hasn't been a great open here. Definitely down test on a day where some people were thinking Santa Claus rally and probably got washed out towards the open here on those. Let's see if we can start making some recoveries, though, as we'll look around. Let's look for some bullish stocks, right, on the day. Wynn having a really good day. Why is Wynn moving up? Well, you guys heard this morning on pre-market prep. We talked about it, right? Well, China officially announced overnight that it would end quarantines for inbound travelers on January 8th. Well, that's going to definitely help out a stock like Wynn. Also help out a stock like LVS. Look at them lead right off the VWAP. This is a trade that I really like often, where a stock comes, and this is a 5-minute, where it comes 3 times to break the VWAP and then recovers, giving you a strong reversal candle on that attempt. Right here, bullish engulfing candle right there, looking good. Now you look for the takeout towards the highs. We'll see if it gets through the 48.21 high from the 935 candle on the 5 minutes. Not a bad move there in Wynn. LVS.
Yeah, well, we just popped over 38.50 here, so the Bulls are making a little bit of a stand. We've had about a 60-point move overall, so a 30-point move, that would take us back to just about unchanged. So really important on this rally here. You have the intraday high at 38.72, and your close is right at that area at 69.75. Boy, I see the China news. It's kind of mixed out of here, right and left. But overall, the win getting a bounce. I pull up the daily here and win, and the two numbers just jump out at me, and that comes if I had a long or was looking for a potential resistance level 84.96. That was your high from last week. Current high 84.49. You also had a high last week at 84.80. So you know what? Good enough to give it a 3-star here as it starts to move up. Also, with this win, big move, and you can thank Tillman Fertitta for this move, right? This was when he started getting back active when he disclosed the stake. This was back in late October. Had very shallow pullbacks. But now with just to look at it fairly from the bulls in the bears in win casinos, this 85 is even becoming more important now, Money Mitch, because your high of the move was just under 90. Your low of the move was just under 80. So it's battling halfway back. I bet you that comes in right at the 85 area. So that's your 50% retracement, trying to negate that move. And then 2 daily highs in here. So taking a look, nice move from win. Now, you're not going to see many green candles like that in the market today. Let's look at some of the other gaming stocks. Are they moving in sympathy here? Well, not a bad monthly candle here for Las Vegas Sands. That's moving up as well. Not as good levels here, I guess, if you're really holding out today. First things first, on the long side, you'd like to take out this 48.50 high. That was a high from a week ago Friday. But the real resistance comes in here at the trio of highs. That's just under 49. So still some heavy lifting to do in LVS. Let's just check MGM here, see how that's traded. They kind of quiet. Looks like a little bit of the laggard here. That chart's not looking as well. What else? We got
MLCO is more
And-
China based. If you want to take a look at that one, Melco Resorts
Okay.
Entertainment, MLCO, just to give you guys one more that's really tied to Win and LVS. If you guys like cheaper names, maybe you like this MLCO. Of course, lower volume on the name like this, still trades 1 million shares on a day, but something to keep in mind if you're looking for some plays like that. Also see specialty retail doing really well. And we talked about those. Would Baba have a good day? Would JD have a good day? Well, looks like they're having a good day on the charts. Not a bad move there. That's why I brought them up this morning. I felt like they could get a nice little move. Look at PDD, nice little 4% day. JD, nice little day there. So not looking too bad in those stocks there as we see some China names get a nice little lift there. Even Dada, I don't even trade this one, but it's getting a nice little push. And it looks like a lot of China names showing up on this. So that just shows me that, hey, it is making the move. One stock also making a little move up. Looks like maybe this is a Santa Claus little type of play. Dick's Sporting Goods getting
Let's
a nice
take
little push on
one.
the day.
Yeah, just let me figure one thing here before we move on. I will take a look at DKS here in 1 second. I just want to take a look to see if we get some more. SPOOs are now into 38.60 handle, folks. We're about to
bounce.
We're going to try and get back halfway on. Boy, we got a lot of numbers going on here. We got halfway back on the session right here at 38.68. We have the close at 69.75. And then and then you got your intraday high at 38.72. So the bulls are fighting back here, just heading to the including the first hour of the session. Good volatility here. We're trying it. We're trying to go green here. Let's take a look at the Dick's Sporting Goods. Excellent customer service there. Nice move up. Wow. I've had a big decline. Just for your Dick's traders here, I just want to alert you. You got a high coming up from the 15th at 115.63. Your current high is 115.33. There's only been, this would make it now 2 highs at that area. Above that, if it really gets into silly town, you can see your next daily high doesn't come up until 118.42. But running into a little bit of resistance here at your 12.15 high. Spoos trying to establish a bid here in the 38.60 handle. Let's just take a look at a couple other retailers here. Macy's, a quiet day. That's up fractionally. Resistance just under 21. What at Kohl's? Kohl's, I was thinking of going there, but didn't. Kohl's is coming up on a daily high here. Let's see if it can punch its way through 25. 25.02 was the high on Friday.
About Nike with the floating island out there. Looks like it doesn't look too bad there. Will this continue? This doesn't look bad. It's held that 116 multiple times. I like that 116 as support now. Let's see if it can keep running on the day. Nike
hasn't given back from that big earnings pop. Look at that. Wow. Matching range days here in Nike, right? Pretty much for the same part. 17.17, your high on Friday. 17.34. It's pressing up here against that daily high. Spoos are helping it out. 119.18. Now, that was the high on earnings day. That would be another target. Spoos are about to go green here. Coming all the way back. You're unchanged right now, back at 50% on the day. Also, your close at 69.75, and then your high here. So this is the bulls did get a little bit of a bounce here, but this is where this is getting important here. You can actually get the index green on the session and get through that new intraday high. Mitch pointed out a great level for our Apple traders. And we've been talking about 129.04. That had been the low for the year. Undercut that low back over 130. Tesla not quite participating as much in the rally. You did take out that pre-market low right back at that area. Spoos are now green here. Now we're gunning for that intraday high at 38.72. So for all you scalpers that just blindly bought the dip here, not off a daily level, but you're coming back to unchanged. Long ways to go for Apple to go unchanged, but keep an eye on some of your issues. Look like we're starting to thicken up on the offer side here a little bit after we just had a 30-point plus rally. So if you happen to catch that dip here, be keeping an eye on here the next turn. We don't have the next half-hour turn until 10:30. Someone mentioned the solar stocks, Mitch. Have you been keeping an eye on First Solar or ENPH at all?
Getting the flush down today with technology stocks. It did get hit hard. First Solar, ENPH. We've been keeping an eye on these. Of course, seasonality is, I think, starting to actually go away from these. So you got to be careful. Seeing multiple highs there really hold well there for First Solar. That's going to be around the 162.20s, 161. If we can't get back into the 162, I wouldn't be looking good there on First Solar. You could be coming back to take out Friday's low, 153.12. If you take that out, you could go back towards the last week Friday's lows. Also prior to that, the 12.16, which is 152.55, and it could be coming down. To me, this looks like a retracement A, B, and now the C move would have to really quickly come back through 162. If not, would let go down through the 150. We'll see what happens.
Try to score some brownie points with Todd Gordon there. I heard
my man Todd. My man Todd.
Yeah, I will look. The EMPH chart is definitely not as clean. I mean, that is just, you're trying to catch a falling knife here. Boom, boom. You do have a daily low that it's breached at 278.07. I guess you got pretty close to that. You got really close to that, 278.13. So you got to be scratching your head whether or not you missed the dip buying opportunity. Wow, the intraday high is way up at 293.03. This thing likes to move around. The First Solar chart, That's a little cleaner to me. I wish we would have been looking at this thing a couple weeks ago. I mean, how many times do you have to hit this 162.20, 162.50 area? You hit it 1, 2, 3, 4, 5, 6, 7, 8 times, and now the pullback. You still haven't taken out yesterday's low. That would be Friday's low at 153.12. Current low 153.77. So getting a little bit of a bounce. The spoos, man. It just got up near unchanged. Did we tick unchanged at 69.75? Yeah, we did. We just snuck our head over on that last bracket. You would have had to have your order out there in order to get done. We did go to 71.25. But now the battle, can the Bulls just keep us bid here up at this unchanged here? Pre-market high comes in at, as I mentioned, way up there at 3,950. It'd be a rare day to go down and take out the pre-market low by that margin and then come take out the pre-market high. But really, the Bulls are trying to apply pressure here, showing a little bit of green on the screen. But right here, we're squaring off. So big move up off the low so far. Spill buyer LM wants to take a look at LMT. And there's a stock that has been strong, right? Been strong this year. Quiet consolidation here. The trend has been higher, right? You have a long consolidation period hanging out near the top of the consolidation period. If I was writing this thing up, I would just have this whole 491 to 492 area. You had 1, 2, 3, 4, 5 highs in that area, and then trying to break out. On the downside, the lows are not quite as clean, right? You do have 2 higher lows, but just something about this 490, 491 area has me a little bit cautious. The Bears are coming out with the offers here. They are making a furious defense of unchanged here. As I mentioned, that was 69.75. We just got to 70.25. Do not see the big boys lifting as much. Apple nowhere near unchanged here. Down $1.89. That's a buck off the low. I think you'd want to see an establish a 130 bid in here in order to challenge that high. Nowhere near the intraday high early too. That was made right off the open. Tesla could find no love. There's no love for Tesla here, even though the spoos have had a nice rally. That continues to make new lows of this. Made a low at 14.12. Can't recover, getting back above 115 as we speak. And now the offers are starting to stack up here in the upper 38.60 handle, defending that unchanged.
All right, taking a look at Apple to see if we can hold above the 130.08. We've had a couple wicks there towards 130.14. If we can get into the 130.20s handle, I think we can start coming back there towards the pre-market low, which would be around 131.11. We'll see if we get that bounce there. Apple definitely battling right above the VWAP. SPY rejected strong in the pre-market low area. So you can see right now that's kind of acting as resistance around the 383 area. We'll see if that holds right now. Do we cut back through there, or do we just come right back to VWAP and create kind of this chop?
What time of VWAP? What time frame?
Yeah, I mean we could go even to the 15 here. So the 15 would be 381.57. So I could see a pullback towards that area and then coming right back, trying to play a little bit of games here. That's why I go towards the 5 minute, and you can see a little bit of topping, could pull back and then give us that next lift. Tesla is the one that's interesting around the 115 area. Of course, you'd have to risk a little bit further down to 114.50. But if you feel we're going to rip on the upward side on the SPY, maybe that's a style trade you're day trading off of. But remember, I wouldn't be swinging even Tesla. I would be maybe more looking for day trades here off the 115. But this is a bearish pattern, right? You're going against the trend. And right now, the trend has been your friend, right? In Tesla, it's been your friend. And look at that hourly chart, right? I mean, look how it's been moving as of late.
It didn't move with the spoos, though. I mean, you just had a 30
didn't move.
It went down to sideways. So if you're looking for stocks to pick on rallies, as of yet, has not. Now, I mean, Tesla, still has a bind of its own, but you'd be made that high kind of early in the session. You'd be really disappointed if you bought that thing, on the dip, and you got the rip in the S&Ps, and no can do here. We did talk about love, and love is getting no love here today. This is a bad day. There's nothing. You did take out the $34 area. The open pretty close to the high. Got a nice gap in there between 34.88 and 35.18. You know what? I could care less about what the stock does. I just wanted my flight to be on time on Thursday. Kind of in no man's land if you're looking at love here on the downside. 33.37 is your next daily low. Your current low is 33.82, trying to get back into 34 handle. I will say, I mean, I'm looking at the date. There is some volume being thrown around here. I know probably Friday was a little bit lower volume day, but I'm looking at some of the other days from last week, and they were 3, 4, 5 million. You've traded 4.6 million shares so far here. And love, that is a big day. So you either got people puking this out, or they're just looking buy the dip opportunity. Bulls and bears are now definitely confused here. The spoos have backed off that unchanged area, but they're certainly not cratering like we did this morning, as we went as low as 37.25. As I mentioned, all kinds of numbers coming into play here. Besides the close, besides the intraday high, the 50% retracement right there. In that area as we speak. So what else do we got to look at? Do we have our next guest ready in the queue yet? Or we could look at some retail stocks for Jay Rice here. A lot of these retail stocks are in the green. Let's take a look at Target. I know that came back down to its low of the move. Not seeing anything in there in the dailies. Good support at 140. I just want to see if if just any kind of resistance level jumps out to me. Crocs, right there, pressing up again. This is a new high for the recent move, showing excellent relative strength. New high today at 104.97. You backed off. I don't have anything for you on that one. What else? You picking a bunch of stocks. Lulu. Let's see how Lulu's trading this morning. Lulu in the green a little bit, getting that support to 310 area. Nothing jumping out for me. That, and then always the wild child, Dillard's, DDS, trying to get ahead above 320. Well, we got the turn there, folks, and unfortunately, it was a turn for the worst. Getting back up there to unchanged, and now after that early morning rally, the Bulls are going to have to try and keep this in the 39.60 handle, and I can't say I'm super optimistic about that. Mitch, what are you seeing?
Yeah, I'm not super optimistic. I just feel like there's some classic stocks getting a little bit of a lift right now, but a lot of the major names still going down here. And I feel like from now, we're just going to be kind of playing a little bit sideways action here. We couldn't get back through the 383 on the SPY. So if I do see that move, I'll look to see if we get some more reversals on the day. But it looks like we did get that 10 o'clock kind of swing right back up, where I usually expect a little bit of reversal action. Doesn't necessarily mean that we're just going to rip, right? We'll see if we can get back through the opening price. Opening price right now, 383.15. If we can recover that, maybe we can get into the green. Right now, it looks like we can't even get into the 383. Big rejection off 382.97. All right, let's go to our guests now. I'm going to go ahead, bring my charts down. We'll keep it going here, team. It's the 3-hour special here on Pre-Market Preps 2023 Outlook. So you guys in the chat, you guys been enjoying this? Hit the thumbs up. We don't do this for you guys every single day, so hope that you guys appreciate all the lineup that Joel set up here for us today. Let's keep it going. I'm going to go ahead and bring our next guest on here, Craig Johnson. You guys know him, Managing Director, Chief Market Strategist at Piper Sandler. Let's get into it.
Good morning, Craig. We usually don't talk to you this late in the day here, but I'm sure you're having a busy day talking to your clients here at year end. And you talked to me about a while ago. Talked about that 3,900, right? And we got a little bit silly. We went to 4,180, and then we got a little bit silly on the downside, going to 37.88. But I know you're busy doing your work, preparing for the 2023 investment year. Could you just, and I asked this question to a lot of the guests that came on, like one thing you think you really got right, and then one thing that like you kind of got wrong.
Well, I mean, I think 2022 was certainly a very difficult year. I mean, we started out in basically the November timeframe, laying out a target for 2022. We started out at a little Van Halen 5150, and we were clearly too high, so we had to make some constant adjustments throughout the year, lowering kind of our price objective. And I think what we got wrong was thinking how hawkish the Fed was going to be. And they kept raising and raising and raising, and the inflation numbers kept building. So I think what I got wrong was how high we actually started to see the 10-year bond yield moving up. I didn't think a longer-term reversal was going to unfold. So what I think I really got wrong in 2022 was inflation, to be honest with you, Joel. And that sort of dictated what we were ultimately going to see happening with a lot of the equity indices at that point in time. What did we get right? I mean, Joel, we got browbeat to death, upgrading the energy sector about 60 weeks ago. And I think we got that square on absolutely right. And probably what we also got wrong at a sector level is we probably should have downgraded tech sooner. And, Mitch, you guys were just talking about some of these loved, FANG-related tech stocks out there. And I think we're entering a period where it's going to be sort of X the technology sector for a while. And you look at a chart of like Amazon, you look at a chart of Apple, you look at a chart of Tesla. These are all distributional looking charts that really don't have any sort of bottom when you look at them on a weekly chart right now. In fact, some of them are actually breaking below the March 2020 lows. That's where the pain's at.
It has been. Go ahead, Mitch.
It's been tough. It's been tough out there. And one of the things that I think, just from someone that, went to college during this time, right? Like this big bull market. And I feel like a lot of the focus had always been on FANG stocks, and I don't blame them on that outlook, right? And it always been just buy the top, buy the top. Well, our leaders are not showing any signs of strength. Should that be signs of worry for us moving into 23?
Well, if I think about Tesla, first and foremost, a Tesla car in Minneapolis to me is sort of worthless, right? When it's 20, 30 below zero, you can't even charge the battery, right? I'll take a Ford Bronco any day of the week over a Tesla at this point in time. That being said, should I be worried about the tech stocks? Well, they are still 20 and change % of the market. But if we have a quick history lesson here and sort of perspective, when we saw the tech sector peak in 2000, we were well over 30% of the entire market. I mean, again, when I say market, I'm not talking S&P sectors. I'm talking about every stock above a 25 million market cap. If I look at all that and add it all up, it was over 30 and change %. Energy at the same point in time back then was about 2 to 3%. And when you saw that reversal take place, by the time you got to 2007, 2008, energy was close to 12% of the market, and you had a four-bagger. So you can still make money. It just may not be in what people have known or the stories that they've been playing. I mean, there's absolutely nothing wrong with the Northrop Grumman. There's nothing wrong with the General Dynamics. You mentioned Crocs earlier, Joel. The chart looks pretty good on good old rubber shoe Crocs too. So there's places to make money. It just may not be the areas that we had previously been discussing and that have been big parts of the market historically.
You mentioned the oil and the energy sector. Is that something that you're going to stick with the strength here? You have the, the turn of, of the year, the, growth value to growth is something that you're sticking with. The stocks are having a pretty good performance, staying a red tape. Are you sticking with what got you there in 2022?
Well, Joel, can I share a screen?
Of course you may.
Yep.
Yeah, we would.
All right. So let's see here. Share screen.
Present at the bottom, share screen, and you'll see the top tabs. You can either share screen or a window. First window will be Windows. Top tab to the right is the
All right. So you can now see the screen.
Yes, got it up here for you.
All right. So let's just to answer your question, Joel, let's answer it by looking at a chart.
Okay.
So these are the total return relative strength charts that we create for our clients. Okay. And on the left is on an equally weighted basis. On the right is a market cap weighted basis. We are above rising 40-week moving averages here, very, very simplistically. And again, this isn't 20 stocks. These are not the GIC sectors. There are hundreds of stocks inside of this total return index, Joel. And I guess my point is, I see no reason to be negative on energy in here right now. Now, compare and contrast, right? Tell me what I should do, Joel, and we'll get you some sort of CMT charter here. But what do you want to do with the technology sector?
Oh,
I mean,
right?
You know.
Okay. And again, I know that this is, a shorter term trading idea thing, but these are weekly charts.
Yeah.
Weekly charts.
That Head and Shoulders don't look pretty.
It does not look pretty at all. And, this has been forming for over 2 years. This is not going to end quickly, and it's not going to end well. So what I'm saying to people is, let's stop thinking about some of these tech stocks for right now, and let's come back and look at what is working in the market. Exactly. And some of the things, and you can pull up some of these charts along the way, but look at Tenaris. We're going to clearly have to have more pipes and steel and stuff like that for the oil industry. Honeywell on a pullback in here. CMI on a pullback in here for the trucks and construction. These are all some pretty good looking charts. Halliburton, Helix. These are all, again, constructive looking charts. And you've got decent things even happening in things like Cleveland Cliffs and some of those kind of names. So I guess the point I'm trying to make is it doesn't just have to be always about just energy. It can be about some of these other names, all about tech. There's a lot of other names in the market that are working. And in fact, one other chart that I want to show you guys real quick too is if I just look at the percent of stocks in confirmed or well-defined uptrends, very simple moving averages, I would make the observation that 78% of the stocks in the S&P 500 right now are in some sort of confirmed or well-defined uptrend. There's always things to do. It just may not be tech at this point in time.
Yeah, and it's interesting to see that it seems like, and from what we just talked about, it seems like the strongest sectors might just be the strongest sector for the next year. There's no reason right now to turn around. And at least the trend is your friend right now. And it seems like in energy, basic materials, industrials, they've stayed strong.
Which is not what anybody is thinking about at this point in time of where leadership in the market should be coming from. I mean, those are all cyclical names. Everybody's looking for a recession. That is consensus. And what if the recession is mild or sort of run of the mill, if we can use that sort of phrase with a recession, because I know it's painful for a lot of people. But if that's the case, maybe this market can work and work better than people are thinking about.
How about that 3,500 low, Craig? We talked about that earlier in the year, and it came down there, bolted out. It was a bad CPI number on that day. It bolted out of there. We haven't been able to make much headway over 4,000. I know on that CPI day, we got to 4,180. We've had a couple guests in that are earlier today. They're like, nah, that 3,500 is not safe. I'm looking for 3,200, 3,300 first before the turnaround. I think the longer we stay above it, obviously, and distance those, the handles away from that level, the better off we are. So if you're looking to deploy some assets here in 2023, are you going to get another look at that 3,500 and below, or got to start nibbling ahead of time?
I don't think you're going to get to that 3,500 and below. And in fact, when we just came out with our 2023 outlook, I titled it "A Hop, a Drop, and a Pop."
I like it. It.
And where I think is happening right now is I put up a kind of a colorful chart here for you. But guys, I think we're in the process of making an inverted head and shoulders bottom. Okay. We know that we've been simply at this point in time making lower lows, and we've been making lower highs. We've been coming right up to this downturn resistance line and failing at it, but we're not getting the violent reaction to the downside the way that we did back here in that kind of August timeframe, the way we did when we hit it back in that sort of March timeframe. We're just kind of sort of meandering around in here a little bit. And I'm just sort of wondering if we get one more sort of hop in this market, and maybe that's part of the Santa Claus rally, and maybe a little bit into the January timeframe, and then you get some sort of bigger drop that ultimately starts to form the right shoulder low. And if I look at the symmetry of this, guys, I would say that, and again, I'm a technician, so I shouldn't always be trying to look forward, but I'm just so tempted to because everybody else is looking forward in the market. I feel like we are trying to make an inverted head and shoulders low, and we just need to form the right shoulder.
Well, what's some of the things that we should maybe be looking for, maybe volume profile as that happens? It seems like we've been getting some spikes in volume, ATR picking up here every time we get in these downside action moves. Should we be looking for maybe low volume at that down point, or should we be looking for higher volume at that down point?
Well, I mean, I think a lot of the selling and some of that had been sort of made right through here. In a capitulation sort of final washout, I would think your volume would probably be a little bit higher on trying to make that right shoulder low. But again, we had such bigger volume coming through these other parts of it.
Yeah.
I wouldn't be surprised to see it as a little bit potentially lower, just sort of a washout in that kind of frame. And why are we going to get this? Well, we know that as we progress through 2023, the Fed is going to have to make some changes. I mean, they can't keep raising rates at the pace that they've been doing. And in fact, they've told us that. So the question is peak hawkishness, those kind of things, where do interest rates ultimately go? I think your hop happens as interest rates start to come down. Okay. We have literally reversed a 40+ year trend in 10-year bond yields. And what do we do when we finally reverse these sort of longer term trends like this, guys, is we ultimately come back and retest. I would not be surprised sometime next year to see a 10-year bond yield 275 to 3. And at that sort of level, stocks are working, probably fulfills the hop. And then as you start to see rates moving back up, it's probably when the drop comes into play, or the drop comes into play when the Fed has gone too far tightening or left rates too tight for too long, and you ultimately sort of break the economy to a degree, and then they have to come back and start cutting. And then when the cutting happens is when you ultimately get the bigger pop. And that's when I think you're going to get a better time to ultimately own equities.
Interesting. Definitely been seeing kind of that same mentality, hop, then drop a little bit further as we start really focusing on those earnings outlook. What do you think breaks first? Will it be the consumer, or will it be the jobs market? Because it feels like it's been tough. What do you think there, Craig?
Well, I think in terms of, again, I come back to these charts. I mean, the consumer is already, if I look at consumer stocks themselves as sort of a proxy for what the consumer is thinking. Here we go.
I love this intermarket analysis that you give out there on Piper Sandler. It's awesome. Definitely.
I mean, the consumer cyclical stocks have already been rolling over to a pretty good degree at this point in time. And I feel like you're already sort of broken. I think your next big thing is probably got to be probably further damage to the consumer in here. I think that jobs is going to be very, very interesting, and is probably your biggest wild card for next year, because if you're an employer, you've got great talent, you've got great employees, you've already got them all trained up. And if you think that, and if you look back through history and how long recessions typically last, they're typically less than a year. Do you really let some of your high performance or high performing employees go in that sort of time frame, and to find the replacement in an already tough job market, where if you were to buy somebody or get somebody else to come on board, you probably got to pay up for them? I would imagine they probably don't let their employees go. They probably cut their bonus. I mean, a bonus is not comp. It's truly a bonus. So I think that's what you're going to ultimately end up seeing. So I think it's going to be more the consumer, to answer your question, Mitch, than it is going to be a big ramp up on the unemployment, because I just think employees are so valuable at this point in time and so hard to replace.
It's going to be definitely something to watch. I'll be waiting to see Does the Fed go extreme? Because that's just the one thing that I've learned in doing my research, just looking back every time. Just seems like they play the extreme game. Something's going to give. Is it going to be the Fed first, or is it going to be the numbers starting to break and some instability coming into play? Of course, the outlook there would be focusing on where does the Fed fund rate reach? What do you think it reaches, Craig?
Well, I mean, people keep talking about the terminal rate for the Fed funds. It could be a little bit higher. Not really sure. I'm not the economist on that side of things. But I guess what I would say from just looking at charts, which I love to look at, I mean, do I look at a chart of Lennar and say Lennar's broken in here? Yeah. I mean, people talk about housing, they talk about the unemployment, they talk about all these other things. I don't know what the exact terminal rate will ultimately be for these things, to be honest with you. I just know that the Fed can't keep going up at the pace that they've been doing. There's a lot of fear out there. The put call ratio has gone way up. The AAII numbers are really high. You got $4.2 trillion sitting in money market funds at this point in time. Any sort of indication that the inflation is sort of been broken, and I think stocks are going to do well. Any sort of indication that the Fed has gone too far, I think you're going to have people coming in and buying that, sell-off in a bigger way, and there'll be plenty of cash. And then that's why I think you'll ultimately get the bigger pop as you move into the latter half of 2023. This is not an untelegraphed recession if we are to get it in any way, shape, or form.
Okay, we've been on the line with Craig Johnson. He's managing director at Piper Sandler, one of our top technical analysis gurus. We always like to have you on the show, and we'll get you on again here early in 2023. Thanks again, Craig.
One last thing, Craig, just because in the chat, there's people wondering, how do we get more information like this from Piper Sandler? What should they do to reach out to you or others at Piper Sandler to get this information?
Well, there's a couple things. One, they could just shoot me an email. Craig.johnson@psc.com would be a great way to, reach out to me. And then, Joel, you guys love talking about shorter term charts. So let's give me one more minute here.
One more minute, of course. Go ahead. What do you got? I'll tell you, I'm looking at the 1 minute, and I want to know if we're going to get if we could get unchanged here. If we could just get a bid above 38.70, I'd be in that rah 3,900 camp. I want the market to end right at 3,900, Craig, right on the nose. And we'll be here on Friday. But give us one more chart. We'd love to see a short.
Yeah, a couple more charts. Take a look at the charts of if you pull them up: AVGO, Wendy's, SHEL, TS, and HIG. These are all pretty good, constructive-looking charts that I think can be bought in here. And those are names that we called out in our weekly piece we just put out today.
Okay.
Wendy's. Right. Hey, get those Wendy's. I can't go wrong. What about McDonald's? Not that one either.
Not quite as good. I mean, I just see starts of uptrends and improvement in momentum with some of these other names out here. Take a look at SHEL too.
SHEL.
Yep. Look at that one.
Yep.
And then the last thing that I want to leave you guys with is one more big picture thing that a lot of people haven't talked about, which is it's only been 9 times since 1979 that we've actually seen the Dow outperform the S&P, the NASDAQ, and the Russell. Okay. Now, more importantly, what has the Dow done in each of those 9 years after having outperformed? This is the forward returns that you look at. And there's your average return. And what if I told you, statistically speaking, that when you had these sort of returns, that if I was to look forward, and again, I know that you want to talk about more short-term things, but I think people want to start to trade this market more to the upside than the downside, because your forward returns 12 months after this period, you've been higher 100% of the time with a median return of 19.57% and an average return of 17.74%. So my point is, this market, I think, can work really nicely into 2023. So don't be able to change your mindset from a trading perspective is what I want all your listeners to walk away with. It's not all doom and gloom. There are charts that are working, and history would say when the Dow outperforms like this, it's a pretty good year ahead, at least for the Dow.
Okay. All right, Craig. Thanks a lot. Like I said, we'll be dialing you up in the new year. Before we get to our next guest, I have some breaking news. Do you have our
breaking news?
Are you ready
Breaking
for some
news.
breaking
We got
news?
breaking news. We got
Do
it.
you- Do you have?
I know I had one that it seems like I took it down. That's my fault.
Okay.
Breaking news. Do-do-do. What's up, Joel? Tell me what's going on.
Loup can't come on today.
Loup can't come on. Is he taking his one day out of the year where he's out?
No, he got if the pictures I'm seeing are correct, he got in a car accident.
Oh man, don't tell me that.
Yeah,
Not good.
and he may have broke his arm. So
that's not good.
I'm in touch. That's why I'm being so rude. I'm being in touch here with Raz and everything, and he sent me a picture. So I think that
sucks to hear.
That's nothing we've ever had happen before on the show. I hope we didn't put the hexamona on him.
Yeah.
But all right. So just before we bring in our final guest here, I'll do the introduction. That unchanged, man. That's just like a repellent. I mean, I don't know how many times we went up there and how many times I had to say it.
Injecting.
So there's your resistance and coming in at, as I said,
New lows on Tesla.
Yeah, dude. That puppy was not acting well. Now,
No.
Not even on the rallies. But our next guest is Rob Friesen, and he's the CEO of Bright Trading, where Dennis and I and Rob all cut our teeth 100 years ago. He has an analytical approach to the markets. It's called StockOdds, and I just wanted to bring him on for a few minutes. And Mitch, and when I talk to you, Mitch, like you talk his language, and I really feel that in the new year I want to try and incorporate your trading style with his. So with no further ado, let's bring in Mr. Friesen.
All right, let's go ahead. Let's do it. Let's get into the StockOdds. All right, welcome to the show, Rob. How we doing?
Not too bad. You guys are so fancy, I tell you. Wow, you just impressed me.
We try to do it right. We try to do it right. But one thing that I can tell you is there's nothing like having some data to support your idea generation, right? And I think that that's really where StockOdds comes into play.
Well,
it can't tell you exactly which one stock to trade, but it can help us, right? It can help look underneath the hood. A lot of traders, let's just be honest, it's a lot of work to look underneath the hood and trying to find seasonality plays, which plays are looking great. And this helps make that learning curve just that much faster, right? Well, tell us a little bit about it. I'll let you guys take lead here.
Well, what I liked about your last guest is rather than just have opinions, there's statistics behind it as well. And I think we all have to do that. One quote we like to borrow, I forget his name now, but it just says, without data, you're just another person with an opinion, right? So we need to have our...
We got enough of those.
Trading, right? I mean, I don't care if you're fundamentally driven, technically driven, or, you want to trade relationships. It's the same thing. So I know that those watching this show are very serious traders, right?
Yeah.
You already know how important it is to manage risk and get consistent results. I mean, you're in this business to make money. This isn't a hobby, hopefully, for most people. So I've taught thousands of professional traders over the years, including Dennis, and this is the most consistent results have come from relationship-based trading, right? Statistically driven trading, and utilizing long and short ideas at the same time generally. So the most consistent results have been from those traders that constantly de-risk long and short ideas in play all the time. So this helps you deal with, bull markets, bear markets, sideways, and choppy markets. So if you're newer to trading relationships, I'd recommend trying our top 10. Through mystockodds.com, we've made these insights and education available to everybody.
What's the process, Rob? What's the process?
Well, just you can contact me and set up an appointment if you want to get a closer look at our database and how we actually use it for trading. I'd recommend a 15-minute or 30-minute appointment if you can. It's a great way just to say, how do we use it? You know, why do we love this stuff? You know, why do we lean on it every day? And I have traders that wouldn't know what to do if they didn't have this type of data to lean on. So you can start with you know, consuming some of our free stuff out there, the seasonality calendar. I'd like to show that if we can. On the
let's
show
bring
here.
it up. Yeah, let's bring it up. Go ahead and share, Rob, if you want.
But this is a very powerful part of this overwatch of this context that we do all the time. How do I share this thing? Present. Okay. Let's see.
Present at the bottom. You're gonna have tabs at the top. One will be window. Right. You start top right is entire screen. If you just want to share an entire screen.
Just want to share one
window. You should see it right off the back there. If not, top right tab will give you the whole screen if you don't want to just do a window. Now, just shouting out from the chat out there, definitely we're taking a look into the markets. It seems like we're still on the leak. As the SPY right back to the VWAP here. We'll see if it catches the bounce there or not. Right now I have VWAP at 381.78. We're at 382.12s here, and we'll see. It seems like 383 acting as resistance right now. Can we actually close above that? Apple looking like another fade. We'll see what happens if Apple comes back down towards the low of the day. Low on the day right now, 128.72. Like that outlook, but not taking a trade today. Going to go ahead and keep it going. Now we got the stock odds. Let's get to it. What do you got for us, Rob? What are you seeing?
So you can get very granular and look at, you know, what stocks are favored on the long side and the short side. And again, the recommendation is to, you know, have ideas for both sides of the market. You know, everybody's always looking for, you know, when's the next bull move, but it's better to trade insulated to that and have ideas for both sides. So you can get granular and look at first trading day of the month, first Friday and all that. So we have lots of ideas for individual stocks, and you can switch it to ETFs and look at that as well. And then you can go to the next page and you can say, I put in gold here because I wanted to bring up a particular theme here. And that is, we've had a year where the US dollar has been in focus. It's had a lot of strength. If that were to ease, it does help lift commodities. It kind of takes that lid off of the commodity area. Gold is one area that I'm just looking into January. So first of all, what's the SPY supposed to be? What's the SPY do historically in January? Well, it doesn't have incredible performance. It's up slightly for the month. And the real benefit happens from the first Friday of the month until sort of the third Friday. Those 2 weeks are kind of the big bubble or push in January, if there is. And part of that relates to, you know, the 30-day wash sale rule where people come in and rebuy stuff that they might have had to sell for tax loss selling. So there's kind of a reason for that bump in the middle of January. But the last days of January are not typically that great. That's always a concern because you've heard before, as January goes, so goes the year. It's not entirely true, but a lot of people use that phrase. But if you're going to get your, you know, bull market in the middle of January, then, you know, you can exploit it. But look at gold versus the SPY. 3.3% for gold for the month of January, only 0.9 for the SPY. So where are we with, you know, our gold trade? We talked about it on the show. Joel and I did a few times. It does seem to be continuing to rise here. So there's possibilities. And this is part of this whole concept of mean reversion. It's been such a depressed area. There's been a number of reasons for that. But it seems to be coming back into favor just slightly. And you can, you know, play it for yourself if you want. But I just wanted to point that out on our monthly, looking at January, and you can put in any ETF here that you want and compare it with the SPY, and that's part of this relationship. You know, how are things performing relative to? And your other guest mentioned the Dow performing relative to the other markets, and that's meaningful. So use this for yourself. This is a free sign up here. There's no obligation. And then the next step is consume some of our top 10 things. You also would want to act quickly, because unfortunately for a lot of our stuff, prices are going up in January, just like everything else in the world. And so, act now, book an appointment with me. I'm available this week if you want to go through our database and look at things specifically. Maybe we want to look at some of the things you trade, and I'll go through that with you. So I'm available. I'm reachable. MyStockOdds.com is the place to go.
And what's your email?
Rob@MyStockOdds.com will work.
All right, Rob. Great information. Thanks for being on. I'll be on with you again tomorrow at 10:30, and then I'll be ending up the year. So thanks a lot, Rob. We'll speak to you again soon.
Thanks for having me on, guys. Appreciate it.
Okay, we're gonna go to wrap
Rob.
here in 1 second. We're still just I don't know how many times I have to say this, rejecting that closed area. Just referring to a question up here as far as what I got right and what I got wrong in this year. I just wasn't aggressive enough on the bearish side with some of the bearish setups and some of the trades that I had. Yeah, they were okay. And then, tried to, be the optimist, flip into bull positions, and it didn't work out. So that's one thing that hurt the performance. Also just wanted to sell some more stocks out of the long-term portfolio. That's not as easy thing to do, but really the only one that major haircuts on, everyone knows, Peloton, but whatever, my girls will have to decide with that. I think the thing that I probably did right was not deploying a lot more assets into the market with available cash, and just kind of waited for the rates to go up. Yeah, you're still losing out to the rate of inflation, but some of the things that I've been able to accumulate in the long term, whatever, I could sit there for 6 months, I could sit there for a year, and then reevaluate to see if the risk is back in the market. So from a personal standpoint, that's where I look at my evaluation. I'm going to wrap things up here on the first long show that we've done in a long time, something that we'd like to do more of here on Pre-Market Prep. We'll get Luke or Jason on tomorrow, because I really wanted to talk to those guys about what Benzinga has in store for 2023. But my final words is, man, we got to establish a bid over 39.70. That's just above the close there. I hate to say it, the path of least resistance is lower. Mitch, how would you like that? I just want to say, Mitch, just a great job today. We had to deal with a couple changes along the way, and thanks for helping out. Just a great improvement I've seen over you over the last few months, and your technical prowess is always helpful. So, Mitch, I'll let you wrap it up, and then we'll shut it down for today.
Yeah, I'll just wrap up with the same question like Joel said, right? What did he get right? What did he get wrong? And I think that one thing that this year taught me is just keeping it simple. You hear Joel say it all the time, the KISS, right? Just keep it simple, stupid. If the Fed is turning interest rates and cutting and going to raising instead of cutting when we were at a zero interest rate environment, well, that should have just told us itself. Don't fight the Fed, team. Sometimes it's as simple as that. Then I think about the other major trade of the year, which was oil. I mean, just look at it, right? That seemed like a very simple trade going into 2022 that a lot of traders even avoided. Maybe it was the XLE that you went after versus just going into one particular stock, right? But overall, if you think about it, from 2022 to where we are from January, let's say January 1st, or it was the 4th, actually the 3rd, to where we are right now, we're looking at like a 58% move there in the XLE. Sometimes it's as simple as keeping it simple, right? We knew that oil would probably get some spike with the war situation. And I think that sometimes like this, it just teaches me, don't confuse yourself too much. Just think about what is happening in the year and keep it simple. A simple bet into the XLE for energy to rise would have been a great move to get on, and not a bad return there for the year. Another thing that I learned this year, Joel, and I think you would like this, is balancing out some portfolio, thinking about this, always having the mentality that it can't just be, high conviction plays in the SPY. We need to be able to have some uncorrelated assets in our portfolios to get around these situations. If we could have maybe some XLE, some energy into our portfolio, just that itself would have been a decent hedge in this environment, right? And I think that that's something that we can take and that I've learned definitely this year. It's always about learning lessons, right? Another thing that I'm going to be trying to implement more and more into my trading is using statistical data, like you just heard from Rob mention, because that's what's really truly going to be the next step, right? I feel like I've gotten to the point where I understand discretionary trades. Now I want to move into non-discretionary trades into my journey as we continue growing right here on Benzinga. You guys can continue growing with us. Joel will keep pushing the levels. I will keep pushing the levels. Try to get towards CMT level 3 next year and see if we can keep pushing. We got this, Joel. Pre-market prep. Where else do you want to be? I don't think
that's
you wanna
it,
be anywhere
folks.
else.
All right, great job, Mitch, and we'll be back at 3:30 with At the Close.
We'll see you at 3:30, team. Don't go anywhere. Hit the like. If you guys enjoyed this, please share this with your following. Let everybody know how great of an episode this was. 3 hours. You guys got 3 hours of pre-market prep here. Hit the like. I'll see you guys at 3:30 right here, Benzinga. Don't go anywhere. Hit the subscribe. If by any reason this was the first time that you guys caught Benzinga, I'll see you guys a little bit later. And we'll see. Can the market turn around? It's bouncing right now. We'll see what happens. The battle's on right here. Will we get back there towards 387? 383 has been acting as resistance. Or will we cut through the low? We'll have to wait and find out. See you guys at the close.